To go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. It is US inflation day. Stocks and bonds sell off with the 10-year Treasury yield at the highest since 2018. Shanghai in crisis. The US pulls out non-essential consulate staff amid widespread COVID lockdowns. Beijing issues its third growth warning in less than a week. Plus, pessimistic about peace. Austria's Chancellor warns of a spiral of violence in Ukraine's east after meeting Vladimir Putin in Moscow. Let's take a look then at the futures after a day of heavy selling on Wall Street, particularly pronounced on the Nasdaq. We saw losses of more than 2%. $1 trillion of market value wiped off the Nasdaq just in the last 5 sessions. We, of course, are keeping an eye then on that CPI print for the month of March out of the US, expected to come in above 8%, and how that factors in to an increasingly hawkish Fed. The FTSE 100 is down by 0.2%. Heavier losses in the IBEX, down 1.4% now, digesting those moves that we saw stateside. And of course, continuing concern about China. Do not forget about China. Do not underestimate the impact on growth. That is particularly the message from Nomura, which says that the risk of a recession in that country, the world's second largest economy, is rising. 373 million people, according to that bank, under some kind of lockdown in China, about 45% of the country's GDP. The CAC 40 is lower by 1.5%. The FTSE now lower by 64 points, or 0.8%. Let's switch it on and see how things are playing out then cross asset as we look at the implications of the consideration around inflation and what that will mean for equities, with yields on the 10-year currently, look, above 2.8. Where do they go from here? Is 3% the cap for yields? Do foreign buyers come back in? Is it looking attractive now? Has the sell-off in bonds been overdone? The future stateside looking to losses of 0.3%, building on what we saw yesterday. Again, the US 10-year, 2.81, up by 3 basis points in the session today so far. The German Bund is in focus. You saw a rise in yields of about 11 basis points yesterday. Part of that a reflection of what is happening stateside as well, but part of that as well a consideration of what the ECB will have to be doing to rein in inflation here. Of course, the effects of Ukraine and energy, all part of the mix. Currently at 82 basis points positive for the German 10-year Bund, just up 1 basis point. And Brent has rallied just in the last 12 hours or so by more than 3%, and $101 a barrel for Brent. There was pressure on that commodity and oil yesterday on the back of concerns about what was happening in China with the lockdowns and that demand squeeze, but currently a gain of more than 3%. Okay, let's get over now to Bloomberg MLive Managing Editor Mark Cudmore. And Mark, you're looking at the yield differentials and FX moves. Good morning.
Good morning, Tom. Absolutely. FX is back. And the reason FX is back is because monetary policy decisions around the world are live again. So just to give some context, FX markets were dead. They were really dead for most of the last 8 years, but really since the pandemic, there wasn't too much movement. It wasn't where the volatility is. So this is a chart of 2-year yields in the US, that's the blue line, in Japan, that's the white line, and in Germany, that's the yellow line. Now you can see from April 2020, post the initial kind of pandemic reaction and then the forward guidance that yields were going to be near zero or negative and not move for a long period of time. They're basically a dead market, 2-year yields, until the last quarter of last year. The Fed meeting last September got 2-year yields in the US into life, and that's when we started this incredible surge. They've done about 240 basis points in that time. Really, really phenomenal move. And that's why we've seen dollar just surge so much in the last couple of months and continue to be very, very strong. On the other side of the equation, we have the white line, which is the Japanese interest rates. They've barely moved. They've nudged up a few basis points, but not much. And that's why we're seeing dollar-yen flirting with 20-year highs, or at least very close to those levels. Now, European yields, they've also weren't moving much into this year, which is why euro-dollar continued to be so weak. But suddenly, in the last few weeks, we've seen front-end two-year yields in Germany really start to surge as people become worried about the inflation impact of the war. And what's actually happened, even though we think of euro being weak against the dollar, which it is because of this gap, we've actually seen euro-yen go to 6-year highs as well. So if you want to know what's driving FX this year, it is all about what's happening in two-year yields, and most of those two-year yields are live again.
And talking of yields, I mean, we're looking at the longer-term space here when it comes to the UK gilts. The 30-year rising that yield above 2% for the first time since 2018. So just building on the picture that you outlined there for us, Mark. Thank you very much indeed. Of course, Bloomberg's MLive managing editor, Mark Cudmore. Yields rising at the long end when it comes to UK gilts. Let's bring in now and get more on what is happening when it comes to inflation print and these key market themes. We'll get to our guests shortly, but we're going to get US CPI figures out today with the White House warning that the data will be, quote, extraordinarily elevated. Investors are assessing the risks to the global economy as the Fed looks to fight hot inflation with a rapid tightening cycle. Fed Governor Christopher Waller says some damage is hard to avoid.
We do not have a policy rule for every segment of the population. We don't have one for every industry. We have one. It's called the interest rate, the Fed funds rate. That's really it. So it's a very brute force kind of hammer that we use on the economy. And of course, when you kind of have to use a brute force tool, sometimes there's some collateral damage that happens. But we're trying to do this in a way that there's not much of it. But we can't tailor policy.
Okay, and arguably we're starting to see some of that damage now reflected across the equities and, of course, the bond space as well. Let's get into the key market drivers with our markets editor, Christina Kino, and Hugh Gimber, global equity strategist at JP Morgan Asset Management. Christina, I want to bring you in first with the rise in yields that we're seeing, 280 now on the US 10-year. How high do they get? Well, we got May in play for the rollback of the balance sheet from the Fed. That's been articulated by Brainard last week. What does that mean for the cap, if there is one, for yields at this point?
Well, Tom, doesn't seem like there is one at this point, especially because we're seeing investors starting to think about 3% levels and beyond, with some of them even looking at 3.5% by the end of this year, understandably because of the rapid pace that we've really seen for 10-year Treasury yields. And yeah, it's really interesting to see whether there's anything that will stop this pace heading into the May Fed meeting, which is quite crucial, of course, because that could potentially be the first avenue for them to deliver that 50 basis point rate hike that we've had several policymakers talking about. But yeah, I think it's potentially not a lot to stop this move until we get there and until we actually start seeing the impact of that policy tightening, both on the balance sheet side of things and the rate side of things. I think it's understandable that people are looking at 3%, could well get there or perhaps just shy of that heading to that May Fed meeting.
Okay, 281 now, Hugh, on the US 10-year. Welcome, good morning. Thanks for coming to the studio. Are we at that pay point now? Do we get to 3%? If we get to 3% within the next few weeks, what does that mean for equities?
So in my view, I think for 10-year yields to stop rising, you need to see the tone from the Fed change. In the context of the report that we're going to get this afternoon, this is going to be another ugly inflation print, and it's therefore absolutely right that now is the time where the Fed have to be talking as tough as they possibly can on inflation. I agree. I think once you move through May, I do expect that we'll get 50 basis points in May. I think 50 basis points in June is also very much on the table. What you need to see is the Fed starting to send signals that they're becoming more comfortable with the inflation outlook, and they can move away from this peak hawkishness where we are now before I think you'll see the move in 10-year yields start to ebb.
So that time frame takes us into July at the very earliest for that change in tone. How much more needs to be priced in by the equity markets?
Yeah, so I think in the equity markets, you're learning now to live with higher yields. You've seen it come through in the rotation from growth to value, from tech to the banks, for example. I still think there's more room for that move to run, because in the context of this year, bonds are going to be jittery. It's not going to be a one-way move higher, but I still see risks to yields to the upside, and therefore when you're thinking about equity allocations over the course of this year, I still think you want to be leaning more into the more value type segments of the market that will fare better in an environment where yields are rising. It's a very different one to what investors have been facing really for much of the past decade.
And Christine, and we'll get more on your allocations after the break. But Christine, in terms of that spillover effect, particularly when it comes to European yields, and we saw that tremendous run up in the German Bunds yesterday, the benchmark up 11 basis points in the session yesterday. Just walk us through the spillover effects and the consequences for the ECB and Madame Lagarde.
Yeah, well, Tom, I mean, obviously we're seeing that impact really play out in the equity space, of course, and some of those high valuation stocks or some of those stocks that people usually use as a hedge against higher yields really getting challenged here because, you know, bond yields at 3% for the U.S. 10-year yield and similar levels for the German and UK yields really are starting to look quite attractive for some of these investors. And so we're already starting to see some calls, for instance, from JP Morgan's Kalanovich saying that it's time to take profit on some stock holdings. And similarly, I think it is creating very interesting moves in the FX space as well. As our Mark Cudmore was pointing out earlier, we're definitely seeing this yield differential play really creating divergences in the FX space. The yen, for instance, really on the back foot and is indeed staring at the precipice of that 20-year low. So a lot of these kind of potential past havens or at least like shelters from higher bond yields really starting to get challenged at this juncture, Tom.
Yeah, the yen is remarkable. 125.64, I believe it's 125.80 or thereafter. That's the line that we need to look for that two-decade low. We'll get more on that debate between Mike Wilson over at Morgan Stanley and JP Morgan's Kalanovich after the break, and some calls as well from Hugh Gimber. Thank you, Christine. We'll be back with you as well after the break. Christina Kino, of course, walking us through the key themes of the markets. Hugh Gimber, global equity strategist, JP Morgan Asset Management, staying with us as well. Coming up, Austria's Chancellor says he is pessimistic about the prospects for peace after meeting President Putin in Moscow. More on that story next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. We are 12 minutes into your European trading day. Losses are more than 1% across the benchmark European Stocks 600. The handoff from Wall Street was not pretty, particularly pronounced the sell-off on the Nasdaq 100, where more than $1 trillion of market value being wiped off just in the last 5 sessions. Every single sector here in Europe is in the red, apart from basic resources, which are just clinging to gains of around 0.2%. On terms of individual indexes, most pronounced selling currently happening on the DAX, down at 1.7%. You're also seeing losses of 1.6% on the CAC 40, lower by 0.8% here on the FTSE 100. Let's look at some of the individual stocks. We've had some trading updates from the likes of Deliveroo, EasyJet, and also some news from the German lenders, Commerzbank, Deutsche Bank, just to bring it to your attention. Deliveroo down 3.5%, this London-listed company, disappointing, coming in with estimates numbers below the estimates in terms of gross value transactions. So a blow to that company, 1.79 billion, it was 700 million below the estimates for that company. So are they losing that traction in terms of the momentum that they built up during the pandemic? EasyJet, we've seen a huge demand for travel over the Easter holiday period, but they're looking at the first half losses coming in at around 535 to 565 million pounds. They say they are still on track to get operating capacity back up to about 80% of pre-pandemic levels. Deutsche Bank down 8.5%. This is on the back of the news that there are some undisclosed holders in Deutsche Bank and Commerzbank as well, looking to scale back their investments. One holder, unnamed so far at least, looking to sell 116 million Deutsche Bank shares. Pressure on that German lender as a result of that, down 8.5%. We'll keep you across those stories if more comes out. Right, let's get back to the geopolitics and what is unfolding in Ukraine. In an effort to push for an end to the war in that country, Austrian Chancellor Karl Nehammer made a last-minute and somewhat controversial trip to Moscow on Monday to meet with Russian leader Vladimir Putin. Following the talks, Nehammer didn't offer a positive view of Moscow's position.
I have no optimistic impression that I can bring you from this conversation with President Putin. The offensive is obviously being massively prepared, but therefore also the clear commitment that a stable access of the International Red Cross is needed.
Okay, let's get more then from Bloomberg's Aggie Cantrell. Aggie, what had the Austrian leader hoped to gain out of this meeting? I said it was controversial because, frankly, it was, particularly amongst some of his European allies.
Yes, exactly. He was the first European leader who's visited Moscow since the beginning of the war. However, he was clear to stress that he had done so while this was not an EU-mandated trip. It has been a trip that beforehand he had consulted with Ukrainian President Volodymyr Zelensky, with European leaders, and also with President Erdogan of Turkey before taking this trip to Moscow. What was key for them to secure was some greater commitment from the Russians in terms of humanitarian corridors. As we're seeing at the moment, as the Russians are starting to regroup around the Donbass region, regroup and resupply their forces there is a real concern for the civilian casualties rising in areas in the Donbass, especially in cities like Mariupol, and after we've heard of strikes on civilians in other parts of the region. And so securing those humanitarian corridors was a key part of his focus. And so when Nehammer was speaking yesterday, he also said that he expected it's the responsibility of the Russian forces to actually make sure that civilians can leave safely, and also for organizations like the Red Cross and other humanitarian aid to get into this region, which has continued to be under siege for over a month now.
Okay, Aggie Cantrell with that important update on what is happening on the ground in Ukraine. Of course, the visit by the Austrian Chancellor to Moscow. Still with us, we have Hugh Gimber, JP Morgan Asset Management's global market strategist. Hugh, let's start with the geopolitics. Where does Ukraine rank for you amongst the risks, the plethora of risks that you and the team are confronting now as you look ahead to the weeks and months ahead?
I think it's extremely important because really it compounds the issue that central banks have been facing throughout this year, which is that in order to tackle high inflation, they don't have many options other than to hit growth. And obviously the situation on the ground remains extremely unpredictable, but what I think we can say with some clarity is that we know growth will be weaker as a result of higher energy prices, and we know that inflation will be higher and higher for longer. So it's really a drag on equity markets. I think what I'll be watching for as we move through earnings season is how we start to see some of the earnings expectations change, because there's been a really interesting disconnect over the past few weeks where you've seen lots of macro downgrades in terms of growth forecasts, but we haven't yet seen those feed through into lower earnings growth forecasts for European corporates.
That earnings growth momentum has sustained the equity market for the last 12 to 24 months. It's been a key pillar, hasn't it? Are you starting to expect downgrades then as that disconnect starts to close?
That's my concern, because really this is going to be a margin story. And we came into this year with margins fairly resilient because corporates had really been able to deal with the higher input costs of last year simply by saying we have a strong consumer, therefore we'll ship those higher prices onto our end customers. And my concern from this point is that when you look particularly at the resilience of European consumers, I think that's going to be challenged this year as a result of the higher energy bills, which is an inevitable consequence of the conflict that we see in Ukraine. So how European corporates are still able to deal with those higher input costs, I think, is now starting to fall more into question.
Which corporates do still have that margin that they can sustain?
Yeah, so when I look to the US, I think margins are likely to be more resilient there. You have a much better insulated US consumer. Yes, it's going to be hard to see margins expand anywhere this year, given the high watermark that we had coming into 2022. But I suspect that the US corporates will retain more pricing power relative to Europeans because simply they're that much more energy independent. They're not going to see the same spike in gas prices that we've had coming through on the continent so far.
We've had a lot of voices just in the last few weeks, it seems, really moving to healthcare as a defensive hedge against all of the risks that are building up now. How much more value is there within healthcare?
Yeah, I mean, in equity markets this year, it's going to be all about that balance between attack and defense. 2021, clearly a very strong year for equity markets. I think this year, defense in equities is going to become slightly more important. And what's different about healthcare is that when you look across the traditional defensive sectors, you have healthcare, you have utilities, you have staples, the others still stand out as very expensive today. Utilities and staples in particular, screening as red in terms of sort of current valuations relative to long-term averages. Healthcare has ticked up, but still looks more reasonable to me. So I think if you're looking for more defensive options within the equity market, healthcare stands out as a decent option. And it's that pricing power story that we've spoken about. I think margins in healthcare are likely to be better protected given their ability to pass on those higher costs to consumers.
And another risk that we haven't and we shouldn't overlook it is what's happening in China. We've got the supply chain constraints, we've got the broader hit on the economy. Premier Li Keqiang coming out for the third time in just a single week warning about the impact on that economy. But then I'm thinking about European equities and corporates that have exposure, whether it's the luxuries or the automakers, that have exposure to that market, and whether or not our markets and investors are underestimating that potential drag.
I think you've hit the nail on the head there, because when you think about the Chinese economic impact, clearly the next few months, the picture is quite murky in terms of the ability for the Chinese economy to grow with the extent of lockdowns that we see today. But when you translate that into the Chinese stock market, you've already had that big derating. So you're trading on 18 times forward earnings at the peak last February. You're now down to between 10 and 11 times forward earnings. So that derating is already in the price. So I think the Chinese equity market is more likely to be able to decouple from a deteriorating Chinese macro picture. I suspect, as you say, that really the full impact of that macro hit to China is likely to be more relevant in the West, where you're going to see higher inflation through more persistent supply bottleneck issues that we were hoping earlier this year might have been fading, and you start to see some of that growth hit coming through as well.
Okay, great insights as ever. Thank you, Hugh, for coming into the studio. Some calls there, opportunities when margins, particularly when you look to the US, and opportunities in healthcare as a sector, maybe as a defensive hedge within these volatile times. Hugh Gimber, global market strategist at JP Morgan Asset Management. Okay, coming up, we get more on Shanghai's lockdown. The details on that is economic and human costs, as we were discussing there with Hugh, after the US told non-essential consular staff to leave the city. This is Bloomberg.
It's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Okay, welcome back to the Open. Let's get to the latest then on the coronavirus impact from China. The US has told non-essential consular staff and their families to leave Shanghai as the vast majority of the city's residents remain under strict COVID restrictions. Let's go to our China economy reporter, James Mager. James, firstly, what is the impact on the ground?
You know, you're seeing a lot of, obviously, most businesses in the city are shut. I mean, some factories, like GM's car factory in Shanghai, for example, are still producing, and there are other, there are a number of other companies which are this kind of closed loop production where all the workers live on site and they're able to work. But lots of companies like Tesla, like VW, for example, in Shanghai, these are all shut. And obviously, any kind of shop or restaurant or kind of services business is shut as well. So the economic effect in the city is it's been very, it's been drastic. And then broader, you're seeing effects on the port. There are more and more ships that are backed up at the port, either trying to offload or unload goods. Truckers are having problems getting across the city because of all the different restrictions and codes that they have to show. And this is kind of spreading out across the country. More ports that are getting backed up, and there are more hits to supply chains happening as well.
James, what are the wider economic implications?
If this lockdown continues in Shanghai, and if there are more lockdowns or there are more restrictions across the country, you're seeing people now talking about a contraction in the second quarter. It's obviously very early, but if this continues, say, for another 2 weeks in Shanghai, if you see border lockdowns in other places which dragged on like this, the effect on China's economy could be very damaging. The effect on Chinese exports could also be quite damaging. Also, the effect of Chinese demand. You're seeing less Chinese demand for LNG now because of it's been a warmer spring, and also because of the less demand because of the slowing economy. So this is not going to be just a domestic story, but it's also going to be an international story. We saw car sales fall 11% in March. That's partly because a lot of the factories were shut in northern China, but also because dealerships are shut because people can't go to their homes. And also there's less demand for cars because people are feeling less confident about the future. They're not willing to buy cars. So the economic effects are wide ranging and are going to continue for a long time.
Okay. James, great update. Really appreciate it. Joining us out of Beijing, James Mager on the economic impacts of this lockdown. Coming up, all eyes on the US CPI. The White House warns inflation may be extraordinarily elevated. We'll get into that next. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. It is US inflation day. Stocks and bonds sell off with the 10-year Treasury yield at the highest since 2018. Shanghai in crisis. The US pulls out non-essential consulate staff amid widespread COVID lockdowns. Beijing issues its 3rd growth warning in less than a week. Plus, pessimistic about peace. Austria's chancellor warns of a spiral of violence in Ukraine's east after meeting Vladimir Putin in Moscow. Let's check in then on these markets. Pronounced selling. The handoff from the US was grim. You saw the S&P 500 closing lower by more than 1.5%. The selling even more pronounced on the NASDAQ, where you saw about $1 trillion of value wiped off that tech-heavy industry in about 5 sessions. You're seeing the European Stock 600, the benchmark, down by 1.2% or 5.5 points. The DAX is also under pressure. Pronounced selling there on the German index, down almost 2%, 1.9% lower. Currently 31 minutes into the trading session, and the FTSE 100 as well, lower by 0.8%. Let's switch it over and see how things are playing out across the sectors then. Basic resources have been clinging to a very modest gain. That has changed now. So much for yields up, banks up. That is not happening now. Banks, the sector that is at the bottom of the list, losing at 2% in the session so far today, despite the fact that yields have been up across the space, whether it's in US, Australia, or German bunds. You saw that 11 basis point move in the German benchmark yesterday. It's a little less pronounced, that sell-off today, but still yields are higher across these benchmark bonds. In terms of how things are playing out then, you got energy just about trade rage bound, near the least badly performing sector, and again at the bottom, financial services, banks and utilities. Let's switch it on and see how things are playing out across some of the individual stocks that we are watching. In fact, we're talking about inflation. We'll get back to those individual stocks, the likes of Deliveroo and others, on the back of those trading updates. We had EasyJet as well, and then Deutsche Bank under pressure. That's part of the drag, certainly, on the German DAX. We're talking about US inflation. That is the key focus for many investors today. We're going to get a clearer picture of whether or not inflation is starting to ebb, or indeed if we are still in this trajectory of higher prices. The White House has warned that the US inflation will, quote, be extraordinarily elevated in March. Consensus sees consumer prices jumping 8.4% year on year, marking the fastest pace since 1982. The US inflation report is due to be released 1:30 UK time today. Stuart Robertson is senior economist at Aviva Investors, joins us now. Stuart, what are you looking for from this March CPI print out of the US? Are we starting to see it topping out now?
Well, we're certainly going to get another increase in these March numbers, Tom. As you say, 8.5 on the headline number, somewhere close to 6.5 on the core number. And you're really seeing a combination of two things. You're seeing the very specific effect of higher energy prices, which of course has been greatly exacerbated by the sad events in Ukraine and the threat to Russian gas and oil supplies. But you're also seeing, I'm an economist, you'd expect me to say this, there's an imbalance between demand and supply. You've had shocks to both, and you're now seeing renewed shocks to the global supply complex. Your previous piece highlighting what's happening in Shanghai, I think, is another example that this effect is not going to go away quickly. So I think we're going to see further price rises in coming months. But inflation is an annual change. So to get that rate pushing higher, you've got to have bigger increases than you did a year ago. And it was really March and April last year that you started to see some of these very large increases coming on. So we're much closer to the top. April might see it. But it's very volatile. There's still a lot of uncertainty, but higher numbers in March.
Okay. Closer to the top, higher numbers in March, and maybe, well, as you say, certainly more volatility. Stuart, at what point, and are you starting to see any evidence that the higher prices are starting to erode that demand strength that we've seen when we continue to keep the focus on the US?
Oh, very much so. You're seeing it already. I mean, they haven't had as much debate or discussion as the cost of living crisis as we've seen over here in Europe. But these prices are biting, and they're extremely visible price increases. You know, when you see it, when every time you're filling up your car and you're paying your utility bills, you're feeling it, and American households are feeling that now. There is a big squeeze on the cost of living. Wages and incomes are going out nothing like as quickly as prices. So the squeeze is very real. And in the US, it's not just about those energy prices. There is a more wide-ranging inflation impulse at the moment because their recovery was quicker, it was further advanced, and there's more underlying strength of demand in the US. So it's not just about energy there. All prices are rising, and households are definitely feeling it.
How far, do you have clarity, Stuart, on how far the Fed has to go beyond neutral to rein in inflation?
Well, I think the clue is in your question. You know, 3 months ago, we would have asked whether the Fed needed to go above neutral. Now that's widely accepted, although we don't strictly know where neutral is. But I think it is reasonable to think that they'll have to go a lot further than they did last time when they reached, I think, 2.25 to 2.5. It's very reasonable to think about a 3 handle, and a number of 3.5, I think, is entirely plausible. That's effectively what the Fed has been telling us anyway. And it seems now abundantly clear to me that, as you say, that in the question, that they have to go above neutral. So I think 3.5 in this cycle is a bare minimum, really. We won't get there in a rush, but we're firmly headed in that direction, and it could need to be hard than that if demand doesn't slow and inflation starts to come back.
Okay, 3.5 is the bare minimum. As we look ahead to Europe, the implications of that then for the Eurozone. Can the Eurozone avoid stagflation at this point, Stuart?
It's very interesting to see this phrase come back. I mean, I kind of resisted its use because I'm old enough to remember the 70s when circumstances were a little bit different. But really, if you're talking about, you know, the combination of very elevated inflation and zero growth, that's the stagnation bit, then I think, sadly, that is a very plausible possibility for Europe in the middle quarters of 2022. Part of that is very specific impact because of the war in Ukraine. So as we've seen in the COVID experience, growth can rebound when circumstances allow it to. But it's an appropriate description of an inflation rate of 6, 7, 8% and zero growth. So I don't think they can avoid that combination in the middle of this year. I don't think it's a kind of secular illness. I think it's a specific set of circumstances that are making it happen. But that doesn't really matter. It's a reality that is going to hurt in terms of low growth and in terms of high inflation. And it produces quite a dilemma for the ECB with high inflation pointing one way and lower growth pointing the other in terms of what they need to do with
quite
policy.
a dilemma seems to be an understatement, Stuart. Do you think the ECB is going to do as much as the markets are pricing at this point?
At the moment, they're suggesting that the ECB will get, I mean, listen to us, we're talking about raising interest rates to zero by the end of this year. It still seems a strange sort of concept. Effectively, that's what the market is saying. So they're thinking the ECB will raise rates to just above zero by the end of this year. I think that's plausible. We'll get some messaging on that from their meeting this week. I think we'll get more detailed messaging in their June meeting when they'll provide new and much more gloomy economic projections, I suspect. I think I'm not sure, and at the moment the expectation seems to be September and December for 225 basis point hikes. I'm not sure they're going to need to, because I think the growth worries will certainly be there over the middle part of this year. And inflation, we know the reason for it. We know, more than half of Eurozone inflation is due to energy prices alone. Now, that's genuine, but is it going to be repeated? I doubt it. So I think by the autumn, we'll be seeing, having had a period of 6 months of very weak growth and maybe inflation retreating, perhaps the ECB doesn't need to do quite as much or quite as quickly as the market's expecting. They certainly don't need to do anything like as much as the US does.
Okay, so possibly a disconnect there between the market pricing and the ECB actions as we start to see, as you predict, inflation starting to wane towards the second half of this year. Stuart Robertson, senior economist at Aviva Investors, stays with us. We'll be talking all things UK in the break, including their unemployment rate falling to the lowest level recorded since before the pandemic, matching levels not seen since the 1970s. We'll discuss the UK economy, as I said, next, the implications then as well for the BOE. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Welcome back to the Open. 42 minutes into the European trading day. Pronounced selling we're seeing across the European space, down 1.7%. You're seeing losses of almost 2% over in Germany on the DAX and 1.9% on the CAC Quarante. Lower here in the UK, the FTSE 100 by 0.9%. Every single sector is in the red today, apart from basic resources, which is range-bound. Banks, at the bottom of the list, down 2.6%. Part of that will be what's happening with Deutsche Bank and Commerzbank, and that brings us to some of the individual corporates that we are monitoring today. And trading updates from the likes of Deliveroo, EasyJet as well. I'll get into those shortly, but it's Commerzbank and Deutsche Bank that are really proving the drag. Look at that, Deutsche Bank down 10.5%, Commerzbank down 8.7%. This is on the back of the news that an undisclosed holder is looking to sell down significant stakes in both of those German lenders, so pressuring the key number 1 and 2 German lenders, Commerzbank and Deutsche Bank, and that is bringing the whole banking sector lower here in Europe. Deliveroo giving an update, essentially not selling as much as estimates in terms of transactions, and so concern about whether or not that momentum that they built up during the pandemic can be sustained, currently down 3% or so, more than 3 points for the London-listed delivery company. Okay, let's get back to what is happening here in the UK, that demand picture, the strength of the UK consumer and jobless, the jobless rate. The UK's unemployment rate has actually fallen to 3.8% in the 3 months to February. It is the lowest rate since just before the pandemic. Meanwhile, UK retailers, well, they've warned that inflation is curbing consumers' demand. The British Retail Consortium has said the 3.1% sales growth recorded in March was driven by rising prices, not volumes. Stuart Robinson, senior economist at Aviva Investors, is still with us. So, Stuart, we have the strength of the labour market, but we know that real wages are falling here in the UK, and then the warning from the Retail Association. What is your level of concern now about the trajectory of growth here in the UK?
I think there's some very significant downdrafts, and you've highlighted the reason why. High inflation is leading to a huge cost of living squeeze. I mean, I've seen reports that it's the most ferocious income squeeze since the 1950s. And, you know, with wages rising at about 4%, but inflation almost double that, you can see that it really is beginning to hurt. And the British Retail Consortium report this morning is showing the impact of that. And I think I talked about it earlier in the context of the US, but anyone who's filled their car with petrol or opened a utility bill in recent months will have, you know, seen these increase in costs in non-discretionary spending. And it's like a regressive tax. It hurts the lowest income parts of the community the most. And those people are really going to feel the squeeze, and they're having less available to go shopping with. And that's what you're seeing in those numbers. I think that's compounded by sort of sentiment issues related to things like the war. Consumer confidence in the UK is pretty low at the moment, and you can see why.
What do we know about the health of the balance sheet, the household balance sheets at this point here in the UK, Stuart?
In aggregate, they're actually in very good shape, despite the sort of falls in equities that equity prices you've highlighted this morning. Tangible assets make up almost half of the balance sheet of the household sector, and that's primarily housing. And the housing market has actually done pretty well over the last two years. Not something you would actually have expected to be associated with a global pandemic, but it's done pretty well. So the household balance sheet in aggregate is actually in very good, it's in rude health. I think the issue is more about distributional things, that wealth is very unequally owned, and it's the people with the lowest level of assets who are going to feel this squeeze the most. That's the lowest income part of the community, and they've obviously been facing modest tax increases as well. So although the aggregate picture is okay, and there's a savings buffer for households overall, I think you're going to see some quite significant distributional impacts, with the lowest income feeling this pain the most, sadly.
So yeah, once again, that those at the bottom of the rung really feeling the squeeze. Stuart, where does this leave the BOE? Do they ease off now on their hiking cycle?
Like the ECB, they're in a difficult position. These forces are pulling in opposite directions. I suspect that they will raise rates again in May and perhaps in June, although that's less certain. After that, I think there's justification for a pause. And in the same way as I said about the ECB, I'm not at all convinced that UK policy interest rates need to go up to 2% by the end of this year, which is what markets are expecting. And you've seen quite a change in Bank of England presentation just in the last 2 months. You know, when they first raised rates, there were 4 voting for a 50 basis point increase and a lot of comment about the dangers of high inflation. The last meeting, everyone voted, or most people voted for an increase, but there was a lot of comment about this income squeeze that you're highlighting on screen there, and that having a major impact on demand. So I think the Bank of England will deliver another couple of rate rises, but after that, there might be justification and cause for a pause.
Okay, renewed uncertainty amongst the policymakers in the BOE. May and June on the cards, but maybe a pause after that amid this cost of living crisis. Great insights. Thank you, Stuart Robinson, senior economist Aviva, for walking us through some of the key economic points on the agenda for us today, the US CPI, what's happening in the UK, and the conundrum for the ECB as well. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The mayor of Mariupol says more than 10,000 civilians have died in the Ukrainian city since Russia's invasion. The country's finance minister told the FT that destruction to infrastructure across Ukraine now totaled some $270 billion. Meanwhile, in talks between President Biden and Prime Minister Narendra Modi, the White House says it made clear the US stands ready to help India diversify its energy imports away from Russia. Chinese Premier Li has issued a third warning about economic risks in less than a week, suggesting heightened concerns about the outlook as COVID lockdowns disrupt production and spending. Li told local authorities that they should add a sense of urgency when implementing policies. Sri Lanka has suspended payments on some foreign debt as it faces dwindling reserves of foreign currency. The finance ministry says all outstanding payments to bondholders, bilateral creditors and institutional lenders will be suspended. The government wants to expedite talks with the IMF and says it's aiming to avoid a hard default. Charity group Oxfam says more than 250 million people could be pushed into poverty this year because of COVID, rising global inequality and soaring food prices. It estimates 860 million people will face living below the $1.90 a day poverty line by the end of next year. Oxfam says food costs account for 40% of consumer budgets in sub-Saharan Africa. The journalist who interrupted Russia's most-watched TV news show with an anti-war protest last month has been hired by German media group. Marina Ovsyannikova will serve as a freelance correspondent for the Welt newspaper and its TV channel, reporting from Russia and Ukraine. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Laura, thank you. Coming up on the show, the Benetton family and Blackstone. Well, they're nearing a takeover bid for Atlantia. The offer for the Italian infrastructure giant may lead to this year's biggest deal. More on that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. 52 minutes into your European trading day. Losses of more than 1% across the benchmark. The pain really being felt in the banking sector, financial services and utilities, all down close to 2%, more than 2%, 2.4% for the banking sector, despite the fact that yields continue to rise. I'm just looking at BTPs, 10-year Italian BTPs, currently up yields by 6 basis points. You're seeing a similar picture for Greek 10-year as well. The US 10-year currently at 2.82. It's the highest level since 2018. Let's get into some of the corporate stories. One of the corporate stories and deal making. The billionaire Benetton family and Blackstone, you've heard of them, well, they're nearing a takeover offer for Italian infrastructure giant Atlantia in what could become the year's biggest deal. Let's get more then with our Milan bureau chief, Tommaso Ebhardt. Tommaso, who is interested then, and when do we expect the offer?
Hi, good morning. Buongiorno da Milano. So the Benetton family already controls Atlantia with a 33% stake. They plan to take it private with Blackstone and some other minority shareholders. They are doing it also in a sort of defensive move because a couple of weeks ago, a couple of other infrastructure funds, GIP and Brookfield, knocked at the door at the billionaire Benetton family, say, hey, we would like to make a pitch and buy your Atlantia infrastructure company. They are backed by Florentino Perez, the Real Madrid chairman, who is also an investor in Atlantia. He owns 50% of the Spanish highway operator Abertis. So the Benetton are doing the bid by themselves to avoid someone else bids for the infrastructure company.
What is the attraction around this company? Why is there so much attention on Atlantia?
It's all started with a tragedy, unfortunately. In 2018, a highway bridge collapsed in Genoa, killing 43 people. Since then, the Italian government forced Atlantia to sell its Italian highway operator, Autostrade per l'Italia. Atlantia completed the sale to a group led by Italian state lender and will get 8 billion euro cash check in the next couple of weeks. So it has to restructure, to revamp the business. It owns the airports operator like Aeroporti di Roma and the Nice airport, and then also highway in 5 continents. So it's easier to revamp and change the business. They're also investing a lot in new mobility services, and it's easier to do it privately than being listed. And then there is a lot of interest on infrastructure assets because of the inflation. Obviously, the tolls road tariff are linked to the inflation. There is a huge interest, and this, yes, it could be the biggest deal this year. The enterprise value of Atlantia is about 65 billion euros.
Okay, Milan bureau chief Tommaso Ebhardt on what could be the biggest deal of the year, walking us through the details. Thank you very much indeed, joining us out of Milan. Okay, let's take a look at some of the things to watch out for today. At around 10 a.m. UK time, Germany's latest ZEW survey, or ZEW survey, is released. Then at 1:30 p.m, we will have, of course, the US data, including that eagerly awaited CPI print. Following at 3:30 p.m, the US aircraft manufacturing giant Boeing announcing first quarter delivery figures. And also today, OPEC releases its monthly oil market. We've seen Brent rallying in the session today. Plus later, Fed Governor Lael Brainard, she made the market move last week, speaks at the Jobs Summit, while her colleague Richmond Fed President Thomas Barkin speaks at an event at New York University. Checking in the markets before we let you go. The Stock 600 is down by 1%. Every single sector in the red this morning here in Europe, apart from basic resources, which was range-bound. Your futures stateside, the S&P E-minis, pointing to losses of 0.4%. That is it for the European market open. Surveillance Early Edition is up next. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I have no optimistic impression that I can bring you from this conversation with President Putin.
We are facing a lot of uncertainty. We're facing rocky waters right now.
Fed funds rate. It's a very brute force kind of hammer that we use on the economy.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, standing in for Francine Lacqua. Here's what's coming up on today's program. It's U.S. Inflation Day. Stocks and bonds sell off with the 10-year Treasury yield at the highest since 2018. Shanghai in crisis. The U.S. pulls out non-essential consulate staff amid widespread COVID lockdowns. Plus, pessimistic about peace. The Austrian chancellor warns of a spiral of violence in Ukraine's east after meeting Vladimir Putin in Moscow. Well, happy Tuesday. Let's check in on markets, and it continues to be one of pain in this global bond market. U.S. CPI on dock. You also have an ECB meeting later this week where we're expected a path towards normalization, not to mention a monster Amazon bond sell, plus mortgage rates moving higher, making it difficult to refinance. All of that means we are selling treasuries and indeed German and UK bonds this morning. So you're looking at a move higher of about 4.8 basis points on your 10-year yield. 2.82% is where that stands. German bond yield for the 10-year, 2015 high. UK 10-year yield, that's up another 5 basis points as well. And all of that translating into pain in the equity market as well. Here's your map of Europe, just right across the board. The one that's doing a little bit better perhaps are UK stocks. FTSE 100 down only 0.7%. Compare that to the DAX down 1.5%. We are seeing higher oil prices today, so that energy complex might be aiding the UK a bit here. CAC 40 notable, it gained yesterday after the first round of the French elections. That is undoing at this moment, down 1.4%. Now, I mentioned the DAX, one of the worst performing regions. Part of that is the individual bank story. Both Deutsche Bank and Commerzbank falling pretty heavily in today's session. Deutsche Bank down 10%, Commerzbank 8.8%. There's an insider, someone who owned these stocks, selling about $2 billion worth of both Deutsche Bank and Commerzbank, about $1.5 billion of Deutsche Bank and $500 million of Commerzbank. We don't know who it is, but we do know that the selling has been heavy. So that's your look at markets. But of course, all of these really dictated on the report we're going to get later today, and that's, of course, the U.S. CPI report for March. Now, that's expected to cement the view of top Fed officials that aggressive rate hikes are needed to fight inflation, which is at a 40-year high. Fed officials saying it will be hard to avoid some economic damage.
We do not have a policy rule for every segment of the population. We don't have one for every industry. We have one. It's called the interest rate, the Fed funds rate. That's really it. So it's a very brute force kind of hammer that we use on the economy. And of course, when you kind of have to use a brute force tool, sometimes there's some collateral damage that happens. But we're trying to do this in a way that there's not much of it. But we can't tailor policy.
We're joined now by Bloomberg's market editor Christine Aquino and Sandra Flippen, chief economist at ABN AMRO. Let me start with you, Sandra, and this language we're hearing out of the Fed. Waller there saying that, you know, it's not a perfect tool, it's a blunt force tool. What do you make of this change in tone from the Fed, going from talking about, you know, we're doing everything we can for a soft landing to, okay, perhaps some economic damage is inevitable?
Yeah, well, I guess it is inevitable, and what Waller calls collateral damage will, I guess, be the American consumer, who's squeezed between, on the one hand, massive inflation, and on the other hand, rate increases. So that's the collateral damage that we're talking about.
Christine, to what degree is that collateral damage factored into this market and being priced in at the moment?
Well, Danny, it's interesting because, you know, we're seeing money markets, of course, pricing massive Fed rate hikes this year. We're seeing it playing out in the bond market. Where we're not seeing it is in financial conditions. You know, those are still quite accommodative at the moment. And this is probably our closest read on the real economy impact of all of this. You know, what we're seeing from the Fed, what we're seeing in the bond yield moves, and the fact that that is still actually lagging behind these more real-time market indicators tells you that perhaps there is quite a delay for the consumer at the moment, and potentially it could get much, much worse before it starts getting better. Because, yeah, I think, you know, the U.S. CPI inflation will be very informative in telling us how much of this is really flowing through to the real economy at the moment and how much of it can actually still come through. And so potentially we could be looking at perhaps a 6-month delay until we start really seeing that peak pain for consumers. And that is potentially bad news, again, for the Fed, which is, again, trying to, I suppose now they're acknowledging that there is going to be a bit more of a bumpy landing rather than a soft, supportive landing for the economy.
Yeah, the financial conditions point, I think, is a really significant one because, yes, we have seen bonds sell off, stocks sell off too. Sandra, I wonder to what extent the Fed put is gone, in other words, in order to really tighten these financial conditions as we look at markets sell off.
Yeah, well, the issue is that financial conditions need to tighten in order for the Fed to be effective, and actually we believe that this is definitely could not be the end of it yet, because what we're seeing at the same time is that if you look at a global index that we have created of supply bottlenecks, that is going back up again after it was actually coming down at the end of the pandemic. But given that China has like increasingly larger parts of its mainland in lockdown, so what we're seeing now is that Chinese demand for oil is going down a bit, which is a relief on the energy prices. But before we know it, it will be the supply that will be affected again from China, and that will mean increasing bottlenecks and increasing price pressure also in the U.S. And that will mean that the Fed will have to very aggressively be hiking in order to get back to its Fed funds targets. And we believe that will be 50 basis points of hiking in May and in June before it can move into a little bit calmer waters of 25 basis points rate hikes.
Christine, you know, what Sandra is describing here, it does feel like an environment where you'd see the curve flatten more, where it'd be the front end that is really reacting to all this. And we have seen this, but in recent sessions, it's been this bear steepening. I mean, what do you make of that that's the trade that's being put on right now?
Well, it's really interesting, Danny, because it tells you a lot about how the markets is trying to assess the Fed's impact on longer-term growth and inflation. And perhaps it is an indication of how much faith they have, or lack thereof, in the Fed in really getting those prices down, because it really has ramped up quite a bit. We're potentially looking at double-digit inflation numbers in the U.S. later today. There's certainly some talk of that coming through. And so when you're in the situation where the Fed, there is this perception that the Fed is quite behind a curve, and that's why we've seen this ramp up in hawkish talk. That's also being reflected in the shape of the curve and the bond market. So it's going to be really interesting to see what those numbers tell us this afternoon and what could be the ensuing response from the Fed between now and, of course, that very crucial May meeting.
Right, and whether the expectation is, okay, this is the peak of inflation, this is as high as it's going to get. Christine, thanks as always. That's Christine Aquino, our markets editor, and Sandra Flippen, chief economist at ABN AMRO, is going to stick around with us. Coming up, how has the soaring cost of living in the UK affected the labor market? We had those figures earlier. We're going to break down the numbers for you on UK unemployment next. This is Bloomberg.
The city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Data out this morning showed that UK unemployment dropped back to its pre-pandemic level at the start of 2022. But wages continue to fall behind the rate of inflation. Sandra Flippen, chief economist at ABN AMRO, is still with us. And Sandra, the numbers showing a 1.3% decline in wages if you take into account inflation. I was talking with Chris Gray of Manpower Group earlier, who said, just put simply, corporations can't afford to pay their employees enough to keep up with inflation. Now, I know you have a different view. What do you make of this gap in wages?
Yeah, well, there are a lot of factors causing the lack of wage growth in the UK, but it's the same story in the Netherlands and in Germany. What we're seeing is that basically corporates are sitting on a lot of cash. Particularly those corporates that have not been that hit from the pandemic, because of course the pandemic was a big blow to corporations, but mainly corporations in the leisure industries. Other corporations have actually pretty substantially seen an increase in the cash that they're sitting on. So I don't think that's the whole argument, but I do have to admit there are two things that are getting hard for corporates. One is that those that are hit by the pandemic, they are suffering from still debt burdens, also sometimes tax deferrals that still have to be paid back, and that could be a burden down the line. And of course, what's now coming into that as well is that particularly for energy intensive sectors, the cost increase from the energy price rises is also squeezing them, because they can't always pass this price increase on to consumers.
Well, it's not, of course, just the UK. This is really a global story of the impact of energy on inflation. And certainly in Europe, that features really heavily. The latest CPI figures, the latest inflation readings, I mean, they just keep charting higher, Sandra. It doesn't really look like there's a peak in sight here. We have the ECB meeting later this week. You have front end of European bonds getting hammered. I mean, are we pricing in really the right amount of aggressiveness that we will see from the ECB?
Yeah, that's a very good question. I think that the markets are a bit overdoing it on the rate hike expectations that are being priced in. So currently for this year, even there is about 50 basis points priced in. We think that's overdone. And that is because we have different expectations on growth and inflation going forward this and next year. So we do expect, of course, inflation is extremely high and it will stay elevated for quite a while. But this inflation is also combined with what we just talked about, the wage growth staying relatively modest. That means that real wages are going down. And those downward real wages are going to affect consumer spending down the line. And this is going to lower growth. So there we basically have competing variables. So one is the inflation going up, incentivizing the central bank or necessitating it to do rate hikes. But at the same time, growth is being lowered. And this is the stagflation scenario that we're all talking about.
How real is that, Sandra, if I can just jump in, how real is that scenario to you? How likely is it that we will face a stagflationary environment in Europe?
I think it's very likely. So I think it's really already in the signs. And actually, we also know that more is coming because China's mainland is for a large part going into lockdowns, and that is going to hit labor supply and output. And that basically will increase the bottlenecks that were just going down at the end of the pandemic. It will go up again, and that will add to the inflationary pressure. And of course, the worry of the ECB is that these supply side inflation dynamics will at some point trickle down into the demand or the broader set of inflation basket. And that will be something that the ECB wants to prevent. And so we do think normalization is still the path that the ECB is on. But we think that once QE is ended, let's say in September, that the ECB will step in with a very mild hiking cycle. So let's say 10 basis points at the end of the year and then maybe 10 more in March. But then the underlying growth reduction will basically cause the ECB to hold its hiking cycle.
Okay, Sandra, hold those thoughts. We're going to continue into the supply story, the demand story more globally in a moment. Stick with us. That's Sandra Flippen. But first, let's turn to the picture in China, where the U.S. has told non-essential consular staff and their families to leave Shanghai, as the vast majority of the city remains under strict COVID restrictions. Residents are frustrated, and the world's second largest economy is under pressure. But China's strict COVID zero strategy remains paramount. Joining us now is Bloomberg's China economy editor, James Mager. James, so perhaps some restrictions seem to be easing, but at the moment, what's the impact on the ground?
Yeah, as you say, some of the people who have been locked down have been able to leave their houses now. They're able to walk around the community. There aren't that many shops that are open. Supermarkets and restaurants, or at least are still closed. So even the people that'd be able to go out can't go anywhere. But And so, the impact on the domestic economy in Shanghai, but also broadly, is still continuing. The port is still backed up. I think you're still seeing, problems with getting trucks, trucking goods across the city. And there are lots of factories also in Shanghai which are also closed. The Tesla factory, for example, is closed. VW's factory is closed in the city. And so, the impact on the domestic economy, on domestic production, on domestic retail sales is obviously going to be huge. And then you add into that the effect that this will have on global supply chains. This is already affecting Chinese demand for overseas goods. It's making it harder for people to land goods like copper into Chinese ports. LNG demand is going down from China. And then obviously if this flows through, if this, these lockdown continues, or you see other lockdowns in other places, and it flows through and makes shipments of Chinese exports slower, it's going to affect, the price of goods in markets in the US and Europe. So, the lockdown in Shanghai looks like it, the government is kind of saying now, they're indicating maybe in another couple of weeks where, they'll get this under control, but the cases are still very high. So you're still going to see this lockdown in Shanghai continue for quite a while. There are other places in China that are also seeing cases, and they could go into lockdown or have some restrictions as well. So it's a very fluid situation, but the effects on the domestic economy, but also the global economy are quite large.
All right, James, thank you very much. That's Bloomberg's China economy editor, James Mager. And still with us is Sandra Flippen, chief economist at ABN AMRO. So, Sandra, you were talking earlier how this is feeding to this view that we're not yet at normalization in this economy, considering lockdowns in China. Is there a length that you're looking for when it comes to the port congestions, to the factory closures that will add to this, or is there scarring already done at this point?
Yes. Well, actually, the figures that James is showing are very, very interesting. I think that we're already so what we're now seeing in China is basically already feeding through the global supply bottleneck indicator. So we've constructed our own indicator consisting of 9 to 12 different images. Indicating global supply disruptions, and there we already see that things are getting worse again. So that is this, and actually, so there is one interesting element here, is because James said that LNG demand is being reduced because people have to stay at home. That is a kind of window of opportunity for Europe, because Europe is basically at this point in time very, very eager to get all the LNG that is out there in the market to fill its reserves in order to survive an oil and gas embargo from Russia. So I think this is an interesting situation. And also the other side effect is that basically the situation in China lowers the demand for oil at the moment, which is also causing a slightly lowered oil price, which is helpful in the whole inflation dynamics, but it's just a short-term relief.
All right, Sandra, I'm afraid we're going to have to leave it there. Thanks so much for joining us today. That's Sandra Flippen, chief economist at ABN AMRO. Now, coming up, Austria's chancellor says he's pessimistic over peace prospects. That's after a meeting with President Putin in Moscow. We're going to have more on that story next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Let's get the latest on the war in Ukraine. And Austrian Chancellor Karl Nehammer has become the first EU leader to visit Vladimir Putin in Moscow since the start of the war. Following talks, Nehammer didn't offer a positive view on the Kremlin's position.
I have no optimistic impression that I can bring you from this conversation with President Putin. The offensive is obviously being massively prepared, but therefore also the clear commitment that a stable access of the International Red Cross is needed.
Let's get more from Bloomberg's Aggie Cantrill. So Aggie, not a positive outcome, or at least an optimistic one, but what had the Austrian leader hoped he would gain out of this meeting?
So the Austrian leader was specifically saying in that briefing that he gave to the press afterwards that while he was not optimistic at the result of the meeting, that he thought that personal, in-person, private discussions were still a key format and an important format for the negotiations ongoing. So that, and while this was not EU mandated, this visit to Russia, he had managed to get to consult with President Zelensky of Ukraine and also with other EU leaders before he went to Moscow. And he was looking at securing humanitarian corridors and pressuring the Russians into allowing for these humanitarian corridors to be established safely, especially in the Donbass region, where we have heard in recent days that there has been a regrouping and resupplying of Russian forces around that region, and there is a clear concern of the possibility of greater civilian casualties in that area.
All right, Aggie, thank you very much. That's Bloomberg's Aggie Cantrill giving us the latest update of the Austrian president there going to Russia. Now, coming up, APB Invest CIO Thanos Papasavvos on the Fed and Russian sanctions. We're going to have that conversation next. This is Bloomberg.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's U.S. inflation day. Stocks and bonds sell off with the 10-year Treasury yield at the highest since 2018. Shanghai in crisis. The U.S. pulls out non-essential consulate staff amid widespread COVID lockdowns. Plus, pessimistic about peace. The Austrian chancellor warns of a spiral of violence in Ukraine's east after meeting Vladimir Putin in Moscow. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, standing in for Francine Lacqua. First, let's get your check in markets. And after Monday's ugliness, the ugliness continues on Tuesday. Anticipation of 8.4% on CPI. There's an ECB meeting. There's a sale, a bond sale coming from Amazon. There's Treasury auctions, all of that resulting in a selling of bonds across this global market. Your 10-year yield up by 4 basis points, 2.82%. German bonds, those yields highest since 2015. UK 10-year yields up 5 basis points. I should say the front end of the curve there in gilts also at a decade high. Meanwhile, equities continue to sell off. European stocks down nearly 1%. Now, looking into the individual regions, some of the ones underperforming, the DAX down 1.5%. We'll get to those movers in just a moment. The CAC 40 also undoing yesterday's gains over optimism of Macron in the lead. The global bond market story, ECB normalization, that taking center stage. UK outperforming with oil up 2% this morning. Now, here's what I was talking about with the DAX. We have this unknown seller of both Deutsche Bank and Commerce Bank stock, about the equivalent of $2 billion, 1.5 for Deutsche Bank, 0.5 for Commerce Bank. Again, we don't know who it is, but at least when it comes to Deutsche Bank, the two biggest holders there who have enough size to have this move, one of them being BlackRock, but of course they are a passive investor. The other one is Capital Group that has a large enough stake. All right, so that's the look on markets. Now let's return to the global economy. Let's reset and the risk of recession on the back of elevated inflation. We're joined now by Thanos Papasava, CIO and founder of APB Invest, along with Bloomberg market editor Christine Aquino. So I think kind of to set the scene here, Christine, I'd like to bring you in and just sort of give us the latest on the speed and move of this bond market sell-off.
Look, Danny, this is unprecedented in a lot of ways. You know, we're just coming off the back of a record loss for treasuries. It's the biggest ever that we've seen, at least in data going back to the mid-1970s. Certainly not something that your modern day bond trader has really seen. And it's really continuing apace. And, you know, I was just looking at the year-end forecast, for instance, for the U.S. 10-year yield. I think they're standing at 2.8% at the moment. So we are there. It didn't take long. We're 4 months into 2022, and we're there for the year-end forecast. People are starting to talk about that 3% and north of 3% level for 10-year treasuries, which again has been highlighted as a particularly painful point for a lot of these risky assets that have been benefiting from lower yields up until now.
Well, Thanos, you know, amid all of this, one of the things that's been really interesting in the moves is that we're seeing bear steepening in the curve. It had been flattening, but that's changed. I know that this is a position that you've had on as well, and it's clear other folks do. So walk me through your thinking there.
Yeah, in fact, we were in favor of a steepening, and we closed our position last March in 2021. We stayed out of the market until we saw it really collapse down to the 20 basis points. And here, the reason why we once again moved in favor of a steepener is looking through the very high probability of an inversion in the near term, because medium term and longer term, these are very good, attractive risk-return characteristics for the yield curve to re-steepen. So it's not a call on the near term. We're very much sort of a view that the curve will invert temporarily alongside the euro-dollar curve, but more medium term, it's a good risk-return position to have.
But I do have to wonder, when you look at this huge deal that Amazon is doing, the 7-part bond auction, when you look at the Treasury selling 20s, 30s, when you look at the mortgage market, those extremely high, and the lack of refinancing, I mean, how much on the long end is sort of more of a technical factor, and we'll have a resumption of the flattening if it is, again, those sorts of things that are causing this move?
I think it's partly that. I think it's also partly the realization of markets that they've been totally whipsawed over the last year, being very complacent in terms of inflation, trusting the Fed when the Fed got it wrong last year. And I believe there's a change in the underlying mindset and awareness. However, my issues, we've been very hawkish on interest rates, and we've been negative on inflation. But my issue is that although the markets have shifted their view for inflation in the near term, they still don't see inflation in the more medium to longer term. And I believe there's still a disconnect between the sort of five-year forwards where we expect that inflation to be and where the markets are. So although the markets are hawkish now on inflation, they're still relatively dovish to where I think they should be 5 years out.
Now that's really interesting, because Christina, I was looking through the Bloomberg economics forecast as well, and they see inflation coming down pretty dramatically after the CPI reading. I mean, is that fair, what Thanos is talking about, this idea that, okay, near-term inflation high, but the market is overdoing it in the medium longer term for how much it comes down?
Well, I think I agree with Thanos's point that perhaps markets haven't come around to the idea that inflation could be elevated for a prolonged period of time. I mean, we have seen an era of below target inflation. This is what we've gotten used to over the past decade. And there's really no reason to think that it couldn't go the other way around, where it just stays elevated above those various central bank targets for a long period of time, especially now that we're in a situation where central banks are increasingly coming to the realization that they really just have been simply behind a curve in terms of tackling this. And thus we're seeing a lot of rhetoric for fast action and immediate action from the Fed and various other central banks.
Would you look at that agreement, perhaps? I don't know, you're about to disagree, Thanos. Break the peace on surveillance.
Not at all. I just think that it's important just to identify what those sort of levels are. In other words, I do expect inflation to remain sticky and elevated, but not at sort of 6 or 8% levels. I think it'll stabilize around the sort of the 3.5% level, which is similar to, I think, what you're saying, just above that sort of 2% target, but not levels where we are now. So stabilize around the sort of 3.5% level.
Yeah, and again, I think the Bloomberg economics, it is about 4% they see, so not too dissimilar, but I guess it is this idea that, you know, 2%, we're not quite there. Christine, just want to change asset classes here for one moment. Marko Kolanovic saying that it's time to take some profit for stocks, which, even though he's bullish on stocks, feels significant because this is a guy who is an uber bull. Is the sentiment starting to change, even among those who are very bullish on this equity market now?
It certainly seems that way, Danny. I mean, like you said, an uber bull who is suddenly saying that it's time to take profit on stocks, probably about as good a signal as you can get in terms of the equity market at the moment. And, you know, it's funny because last week we were kind of discussing this idea that equity markets, given their resilience despite the bond sell-off, seemed like they weren't really willing to believe that the Fed is about to really go on this massive tightening cycle until they finally see it. But it looks like this week the narrative has shifted quite a bit. I think that those levels that we crossed on 10-year Treasury yields really driving home the point that there is this massive quantitative tightening cycle that's about to come. And it's really not just on the rate hike side of the equation. The Fed reminding us last week as well that they have this other lever, which is the balance sheet runoff, which A combination of both of those would be potentially powerful.
Okay, we're going to have to leave the conversation there for now. Thanos, I know you want to comment on equities too. I'm sure I can feel it. We'll get to that in just a moment. Thanks so much to Bloomberg's Christine Aquino. Thanos Papasavas, CIO and founder of APB Invest, is going to stick around with us. Now, White House economic advisor Brian Deese says the Biden administration expects an elevated consumer price index when numbers are released this afternoon. Deese spoke to David Weston on Balance of Power.
Certainly, we are expecting an elevated CPI print tomorrow, and that will reflect the month of March. And the month of March is where we really will see and have seen the impact of President Putin's invasion of Ukraine on energy prices and other commodities. We know that because we've already seen what's happened to gas prices in the United States, and that will be reflected in what will likely be a big divergence between the headline and core. The real focus now here in terms of looking forward is what we can do to try to mitigate that run-up in prices. You've seen the president take some significant actions like the historic release of oil from the Strategic Petroleum Reserve, and how we can provide some relief to consumers who are feeling the brunt of those increases. Our hope is that if we can move forward on those efforts, we can stay focused on the task at hand, that we will see inflationary pressures moderate. We'll be lower at the end of this year than we are today, and lower still in the coming year. That's our focus, and that's our hope.
White House economic advisor there, Brian Deese. Now let's get to the first word news. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny, and thank you. The U.S. has told non-essential consular staff to leave Shanghai, with the vast majority of the city's residents still under strict COVID lockdown. On Monday, Shanghai said it was easing restrictions in compounds which had no infections in the past 2 weeks. However, details published overnight suggest the number of people released is smaller than actually suggested. More than 23,000 COVID cases were reported on Monday, a reduction from Sunday's record total. Now, Sri Lanka has suspended payments on some foreign debt as it faces dwindling reserves of foreign currency. The Finance Ministry says all outstanding payments to bondholders, bilateral creditors and institutional lenders will be suspended. The government wants to expedite talks with the IMF and says it's aiming to avoid a hard default in the country. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Coming up, we're going to break down how the soaring cost of living in the UK is affecting the labor market and continue the market's conversation next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Now, as yields have moved higher, stocks too have moved lower. You're looking at a real yield that has climbed closer to being positive. And amid all that, that's the earnings picture we're just looking at. Here is your relation between the 10-year yield and NASDAQ 100 stocks. That index has erased more than $1 trillion over the past 5 trading sessions. Still with us is Thanos Papasava, CIO and founder of ABP Invest. Thanos, so you turned more negative on S&P 500 in February. You're hanging on to that. Walk me through your call.
Yeah, we turned negative on the S&P partly because of our view that the Fed was behind the curve. They have to overcompensate. The risk of them making a mistake and sort of tilting the economy over to a recession is higher. We don't believe that the Fed will be able to deliver all the rate hikes that it's pricing in. And we also talked about earlier about the inversion of the euro-dollar curve, right, the US just 10s. So we turned negative the S&P in February. We also more recently turned negative the US high yield market. We had been neutral. We had turned negative the investment grade last summer, but we didn't turn in high yield. We didn't see the risk of recession. But now, with the risk of recession slightly more elevated and spreads from a valuation point of view slightly tighter, we also turn negative. So negative US high yield, which also correlates to negative European high yield.
So, I mean, this is a very risk negative view. Like a lot of these risk assets that perhaps would have given you that juice, that return in your portfolio. What does that mean if you can't rely on those right now?
No, I think that's a very fair point, and this is the discussion that we're sort of having broader within the asset allocation. Where do you readjust? So within the S&P, our preference would be for value versus growth. So there's a preference there. However, there are some areas, such as, for example, some of the emerging markets, which tend to be further away from the epicenter of the Russian-Ukrainian war, such as Latin America, which have done well, very much underpriced by the markets and super well delivered in terms of the central bank policy. So there are pockets of opportunities, but it's more of a tactical rather than a strategic asset allocation view. And also alternatives and commodities, which are likely to benefit within the space of higher inflation.
So it's enough that we have that threat of recession to turn us sour on stocks, on high yields. We don't actually need to see a recession, is that correct? Or is this a call that it's going to be recession in 2023?
It is difficult to be fully confident of that, because our own quantitative models and the broader recessionary models don't have a high probability of a recession, because we're looking at the labor markets, which are super tight, financial conditions indices have not tightened yet. So if you like, it's a qualitative view that the probability of recession is increasing, triggering us to make those shifts. But it's not, we don't have the confirmation yet. It's a preliminary preemptive call of a recession.
Right.
And we could be wrong.
Yeah, but you're not alone, right? Certainly more of that sort of, we could see an elevated risk of recession. That certainly has been filtering through. Thanos, thanks so much for joining us this morning. Really appreciate it. Fascinating conversation. Thanos Papasava, CIO and founder of ABP Invest. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Danny, good morning and thank you. Chinese Premier Li Keqiang has issued a third warning about economic risks in less than a week, suggesting heightened concerns about the outlook as COVID lockdowns disrupt production and spending. Li told local authorities that they should add a sense of urgency when implementing policies. Now, the billionaire Benetton family and Blackstone are said to be nearing a takeover offer for Italian infrastructure giant Atlantia. Bloomberg understands a plan to buy out and take the company private, which could become 2022's biggest deal, could come as early as tomorrow. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Now to the UK, where Boris Johnson has approved an inquiry into Chancellor Rishi Sunak's financial affairs. Sunak asked the Prime Minister for a review in an attempt to draw a line under growing questions about his financial arrangements after details of his wife's tax status and his U.S. green card emerged. A government spokeswoman said the Prime Minister has offered his full support to Sunak. We spoke to the UK's Economic Secretary to the Treasury.
I recognise these are challenging times for him and his family, but he will come through them. But his focus is on doing what it takes to get the British economy into the right place through these very, very difficult times. And he's made a number of interventions dealing with the thresholds of when you start to pay national insurance and tax, support for the least well-off in society. Of course, there will be many who will say there's more to be done, and he will look to the future fiscal events to address some of those concerns.
How do you feel when, as a member of, Conservative Party, looking at really what ethically it's being judged at by at the moment? When we think of the Partygate, the leader of your party underwent, when we look at the Chancellor of Exchequer, who seemingly just doesn't seem to be in touch with reality, many people feel that, and he's holding a green card at the same time as being Chancellor of the Exchequer, what sort of really tethering he has in the longer term to the country. And then you, of course, I mean, nothing to do with you, I realise, but certain, today, just the unseating of an MP and a crisis election because of, previous misdemeanours when it comes to sexual abuse. I mean, how does it make you feel when you're trying to stand up here in the US and defend your Conservative Party?
Well, I've been in this post for nearly 4.5 years. I'm the longest serving economic secretary we've had in the UK. It's a great privilege to do this job, and I, like the Chancellor, focus on the task in hand. I've done that through 3 Chancellors, and I've always been impressed by the professionalism of the people I've worked under, and there's no difference with Rishi Sunak, who's a first-rate boss, a first-rate Chancellor. And I have absolute confidence in that he will come through these difficult moments, and we will see what can be done in terms of future fiscal events of the budget.
UK Economic Secretary to the Treasury John Glenn there speaking to Caroline Hyde about Chancellor Rishi Sunak's tax row. Coming up, waiting for Elon Musk's next Twitter move. The Tesla chief may raise his stake in the social media company after declining to join the board. More on that story next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Speculation is mounting over Elon Musk's intentions for Twitter. The Tesla CEO had declined a board seat, raising the prospect of the potential acquisition of more shares in the social media company. Last week, Musk disclosed that he had a stake of just over 9%, becoming Twitter's largest individual shareholder. For more, we're joined by Bloomberg Quick Takes Alex Webb. And of course, the idea of him buying more shares is this idea that he would have been capped if he had joined the board. But during the break, we were just discussing this idea of what it would mean for him in terms of fiduciary responsibility should he join the board. Walk us through that as to why that might not have been attractive for Elon Musk.
I mean, essentially, he would have had guardrails imposed on him, like perhaps limiting some of the things he could tweet, but also like making him commit to acting in the interests of all shareholders, not just himself. And if we look at the things that he's doing at Twitter, if we look at the size of his stake, it doesn't really look as though this is a financial play. He doesn't need the money. Right. He's worth $270+ billion. This stake he probably acquired it for about $2.5 billion. It's less than 1% of his net worth. So if it's not really a financial motivation, it's about influence. And if it's about influence, then maybe it's not going to be the interest of all shareholders, whatever he has in mind. And so perhaps it means he doesn't have that legal obligation anymore. He can remain outside the tent throwing things into it.
But how does that work in terms of what he can actually get done? Because if I just apply perhaps some like very circular thinking here, but if Elon Musk is pressuring Parag Agrawal to do something, but that's only in the interest of Elon Musk, it doesn't serve all shareholders. I mean, are these things that Twitter can actually implement?
Well, the thing is, he does have the ability to clearly build a bigger stake, and that is a sort of Damoclean sword hanging above Twitter now. It is something that if he does so, he can then think about agitating for more board members who would perhaps be beholden to him to a greater extent. But he is now still able to corral his however many tens of millions of Twitter followers that he has, and not just be on the inside as perhaps a solitary board member talking to the other 11 members.
I mean, there's also been some weirdness in terms of SEC perhaps enforcement or some confusion around when he filed and what forms he used to file. Does the fact he's not on the board make things simpler? Would it have been more complicated if he had joined the board? How does that factor in?
I mean, it certainly limits some of the punishments because they couldn't say, well, he can't be a member of the board. If he's, that would have been an obvious thing that if he had broken some rules, then they'd say, well, you can't be a board member for a number of years. But now that isn't a punishment. Look, there are circles within circles here. It's vastly complex. I think the key thing is, like, I'm not sure that even Elon knows exactly what he's doing. Right. He's throwing a lot of chips up in the air, seeing where they land. And for him, don't forget, Twitter's not a big company. Twitter's a sort of $37 billion market cap company. Twitter's revenue is the same amount as BT's profit. It is 5% the size of Facebook by market cap. His ability then to just nudge things around is a lot greater than it would be if he had, say, gone into Meta, for instance.
Right. What I'm gathering from all of this is just to be prepared for more wacky Twitter polls from Elon Musk.
Exactly. And don't turn on your notifications for him tweeting.
Yes, exactly. Alex, thanks so much. As always, that's Bloomberg's Alex Webb, who's been keeping us on top of the Twitter story throughout the week. Now let's get to your market check. We're looking at S&P 500 futures just barely turning positive, or maybe they're a little bit negative now. A lot of back and forth, but NASDAQ futures, those have turned positive, up 0.1%. Some of the losses in treasuries easing a little bit. That's perhaps allowing the outperformance of NASDAQ, but still awaiting CPI that could certainly impact what futures, the stocks, and of course bonds do if that sell-off continues. Well, Bloomberg Surveillance Early Edition continues the next hour. Matt Miller and Kaylee Lyons in New York and Anna Edwards out of London. This is Bloomberg.
of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The recession chatter is ubiquitous. I mean, it's everywhere.
We are facing a lot of uncertainty. We're facing rocky waters right now.
What we're really seeing now is an increase in volatility as the market really is positioning itself for the Fed to be more aggressive.
Looks like a Fed that has to fight the world from the top side.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, April 12th. Our top stories today. European stocks are falling again while U.S. futures fluctuate and the Treasury 10-year yield exceeds 2.8%. Data coming out today may show that March was the high water point for inflation in the United States. Catastrophe in Ukraine. The mayor of the city of Mariupol says that 6 weeks of fighting left more than 10,000 civilians dead. And in China, a sign that COVID lockdowns are taking their toll on production and spending. Premier Li Keqiang issues a third warning about economic growth risks in less than a week. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it seems to be expectation of a high level of inflation in the United States, kind of taking the wind out of risk assets globally.
Yeah, we could be looking at an 8 handle on the CPI figures later on this morning. So that is definitely something that U.S. investors have to consider. For Asian investors, though, of course, that session took place before the data comes out, and it really was mixed. You had the MSCI Asia Pacific Index lower by a few tenths of 1%, but Hong Kong and China actually outperformed. China, of course, still dealing with the lockdown in Shanghai. That has led the U.S. to say non-essential government personnel should pull out of the city. And yet Chinese stocks actually rose about 2%. There is a lot of speculation that officials are going to step in to shore up growth in the economy in the face of that COVID-0 policy. And of course, outside of the equity market, we continue to see the global bond sell-off rippling across the world. True, too, in Australia, where the 10-year yield was up 7 basis points at 3.08%. That is the highest going back to 2015. Meanwhile, the Japanese yen weaker once again against the dollar as the dollar strengthens with higher treasury yields. Right now sitting at 125.64. That is the weakest yen going back 2 decades, all the way to July of 2002. And finally, also, Matt, we have to make note of Sri Lanka today. The country warning of a potential default, halting payments to some foreign creditors, really trying to preserve its dollar stockpile for things like fuel and food as it's facing protests around inflation in the country. So that took Sri Lankan debt maturing in July of this year down to 46 cents on the dollar. That is a record low, Matt.
Yeah, a default there, maybe a warning sign for the world, right? Because as prices for food and fuel rise that are priced in dollars, a lot of countries don't have enough dollar reserves on hand. So this is a real concern. Take a look at what's going on in the U.S. Not a lot of movement in S&P futures, but we were down in the cash trade 1.7% yesterday. And you can see the U.S. 10-year yield also continues to rise 2.8167%. So more than 2.8%. That's the highest level since 2018 now. NYMEX crude right now is up about 3.6%. It was down 4% yesterday. So it's kind of bouncing back from yesterday's losses at 97.67. Brent, by the way, at one point this morning was below $100, the global benchmark. It's back up over that price now, though. And Bitcoin rising 0.8%. So maybe a risk on sign for later on today in trading, 40,162. So still a relatively low level compared to where we've seen it over the past few sessions. Anna?
We've got a pretty bleak picture here for European stocks right now. I can tell you we're off lows, but the German market's down by 1.1%. The French market's down by 0.9%. Some of the data continues to look gloomy out of Europe's largest economy, and that is the German ZEW investor expectations. So a survey of financial service professionals, just what do they expect from the year ahead? That reading has come in at minus 41, sorry. The estimate was for a drop of minus 48. So maybe not quite as negative as had been anticipated, but we'd already seen the biggest drop in this particular survey data since the early 1990s in last month's survey, of course, reflecting war on the Ukraine, which would have surprised many finance professionals as much as everybody else. Let me take you through what we're seeing on certain German banking assets. So sticking with the German theme, we've got Commerzbank and Deutsche Bank moving lower this morning, quite substantially so in the case of Commerzbank, but really off earlier losses. We've seen some of these stocks down by more than 8-9% in the early part of the trading day. A big holder of these companies selling these stocks today, trying to raise around $2 billion in the process. The holder's identity currently unidentified. The Brent crude price up by 3.6%. So things have been looking a little bit more normal as we come back down from those $120 a barrel levels that we'd seen recently in recent weeks. But still, we are seeing quite a lot of volatility with quite a sizable move this morning in Brent crude. And I put in the UK 10-year yield just to highlight the global trend, of course, is still a big focus on higher yields. That's true in the US, as we were hearing, but also here in Europe with German and UK assets, but also to highlight the tightness of the UK labour market. We had jobs data out today, the tightest labour market, we understand from Bloomberg News colleagues, in living memory. On Russian assets, then, the global theme still applies. We are seeing a pullback from global equities, concerns around the pace of the rise that we're seeing in yields globally, and in particular in the US, weighing on Russia as in elsewhere, and we're seeing the index there down by 2.5%. The Russian ruble in focus. We had these interesting comments earlier from President Putin, Kaylee, talking to IFX news agency, saying that he has no intention of cutting Russia off from the world. But there we are, Russian ruble 83 at this point of the trading day. Kaylee.
Yeah, and I guess the question is how much that choice is Russia's and how much that choice is the rest of the world's. Now a look at what is ahead today. We will be getting more Fed speak. Fed Governor Lael Brainerd and Richmond Fed President Tom Barkin will be speaking to these markets. President Biden also will be traveling to Iowa for the first time since the 2020 election. And of course, the big event of the day, inflation data in America. We'll get U.S. CPI at 8:30 a.m. New York time. For more on that, Mike McKee, Bloomberg International economics and policy correspondent, joins us now for more of what to expect. So, Mike, an 8 handle we're potentially looking at here.
Yeah, you know those horror movies that they just do sequel after sequel after sequel and finally they run out of gas? We're hoping that this is the horror movie that's going to run out of gas in terms of inflation, because you look at the numbers, as Kaylee said, the year-over-year number is expected to come in, according to the Bloomberg survey, at 8.4%. It was January of 1982 when we had a giant cold snap, by the way, 9 degrees below zero in the Cincinnati Bengals playoff game. The last time we saw a number like that, a little bit later in 1982, 6.6%. So this is really going to get the attention of people in the markets. But since I've been giving you the bad news, let me give you the good news. This could be the peak of inflation for a number of different reasons. First of all, this is the monthly inflation change. And as you can see, in March, April, May, June of last year, inflation came in very, very high. That's what's called the base effect. So now whatever we add to that isn't going to be as much. And so starting with this month's numbers coming out next month, we will see lower inflation on a month-over-month basis. And then here's the good news. Gasoline prices have finally started to roll over, and that will mean less of a contribution from energy to the overall inflation rate, and that should be some good news. The bad news there, of course, is it's still going to be very high for quite some time.
Yeah, absolutely. It doesn't come back down after it goes up, or at least not very quickly. Michael McKee with a look at inflation. We'll be paying very close attention later on to the CPI release, just about 3.5 hours from now. The relentless sell-off in treasuries continues. That's something you can't not pay attention to, threatening to mark a resolute end to the 4-decade bull run in bonds. Let's get more with Bloomberg's Danny Berger. Danny?
I'll continue the Mike analogy and say this is the horror movie that we can't turn away from. And it is a global sell-off in bonds. So it's the CPI figures. It's also an ECB meeting later where they're expected to head towards normalization. It's this monster bond sale from Amazon, 7-part offering, and high mortgages that has dealers ditching treasuries. So what does that mean? It means that this 40-year bull market we're seeing in treasuries, if you were to map out the trend line on that on a log scale for a radio listening audience, we have just barely pushed above this. It's not just treasuries, it's also the German bond market. 10-year yields, those are at their highest since 2015. Front end of the yield curve, it's highest in over a decade. It is angst rippling through the entirety of the bond market, and that's having a ripple effect on the stock market. And it's really those sort of longer duration equities, specifically tech. The NASDAQ 100 has sold off in the past 5 sessions, wiping out $1 trillion in market value. The sentiment is certainly changing here. The latest Bank of America survey has record gloom about this economy, highest assumptions of stagflation since 2008, and in a sign that sentiment is also starting to change. Uber bull Marko Kolanovic over at JP Morgan says it's time to start taking profit on U.S. stocks. Anna, this is someone who time after time he says safe to be in U.S. stocks. So he's talking more from a valuation standpoint, but still significant. We're starting to hear a change in tune from bulls.
Danny, thanks very much. Bloomberg's Danny Berger with what the rising yields is doing to stock markets. Now, let's get back to the geopolitics. Ukraine expects Russia to widen its offensive in the east of the country this week. Troops are likely to try and take the port city of Mariupol, where 10,000 civilians have died since the invasion, according to the mayor of that city. The Austrian chancellor met with Russian leader Vladimir Putin yesterday, but didn't offer a positive view of Moscow's position.
I have no optimistic impression that I can bring you from this conversation with President Putin. The offensive is obviously being massively prepared, but therefore also the clear commitment that a stable access of the International Red Cross is needed.
For more on the war in Ukraine, let's get to our reporters in Berlin and in Washington. We'll begin with Aggie Cantrell in Berlin. Aggie, the Austrian Chancellor repeated warnings we've heard in recent days about the preparation for a massive Russian offensive in the east. What can you tell us about that?
Yes, so there's a real concern on the part of NATO allies and Ukraine itself that essentially Russia is reinforcing and resupplying their troops in the Donbass region. This region, which has been disputed for a long period of time, since 2014, and is going to be what Russia is looking at in terms of territorial concessions from Ukraine in order to eke something out from this conflict that's now going into its second month soon. And so what we're seeing is that Russia is repurposing all of those troops that had been withdrawing from places like the capital, Kyiv, and they're looking at redirecting them to this region in the Donbass in order to pressure Ukraine to help Russia get a strategic corridor from Crimea to Russia, essentially bordering the country. And so that's what they're focusing on. And so the words of the Austrian Chancellor yesterday and from other leaders, they're very concerned about civilian casualties mounting in this region, especially in cities like Mariupol that have been under siege since March 2nd.
Yeah, and we understand there's already been thousands of civilian casualties already. Thank you so much to Bloomberg's Aggie Cantrell. Now, President Biden struck a more upbeat tone in a virtual meeting with Indian Prime Minister Narendra Modi yesterday. He said the two nations will keep working together to counter the fallout.
The United States and India are going to continue our close consultation on how to manage the destabilizing effects of this Russian war. And I'm looking forward to our discussions today, Mr. Prime Minister. Our continued consultation and dialogue are key to ensuring the U.S.-India relationship continues to grow deeper and stronger.
Emily Wilkins, Bloomberg government reporter, joins us now from Washington. So, Emily, more cooperation, but were there real tangible outcomes from this meeting?
And at this point, that does remain to be seen, Kaylee. We know that President Biden told Prime Minister Modi that the U.S. wants to help India diversify its oil and its natural resources. And we also know that White House Press Secretary Jen Psaki said that Biden did warn Modi to not increase or accelerate his purchase of Russian oil and gas. Now, that doesn't mean, of course, that the U.S. is looking for India to no longer purchase any Russian oil. Biden really didn't give a commentary on that particular piece of it. Usually with India, they tend to remain a little bit neutral between some of these larger world powers. But we are seeing a headline cross the terminal this morning saying that India is going to boost shipments to Russia by $2 billion. And of course, this isn't oil and gas, but these are some items that are impacted by sanctions, things like pharmaceuticals, textiles, machinery. And so it'll definitely be interesting to watch this relationship between U.S. and India and Russia, and kind of what dynamics are at play here. Certainly, India has a stake with both nations in terms of future shipments, future assistance with defense weaponry, and is certainly, at this point, seems to be trying to find that neutral space in between the two of them.
All right, Emily, thanks very much. Emily Wilkins there from Bloomberg Government in Washington, D.C. Over in China, the Premier Li Keqiang is issuing his third warning in less than a week about risks to economic growth. This suggests more concern about the outlook as widespread COVID lockdowns disrupt production and spending. Let's get more with Enda Kern, our chief Asia economics correspondent in Hong Kong. So, Enda, it looks like we're getting, real profit warnings for the country.
Yeah, exactly, Matt. It's a third warning, pretty unusual, and he's now speaking of the need for urgency in tackling what's going on with the economy. We know, of course, that the aggressive controls on COVID is at the heart of all of this. We're seeing declines in house sales, declines in car sales, and now, of course, our colleagues are reporting that excavator sales are coming off as well, one of the leading indicators for China's construction sector. Nomura are out today saying that there could even be a contraction of growth in the second quarter. And indeed, they made the point that the rest of the world isn't keeping a close enough eye on what's happening with China's economy because of what's going on with the Russian invasion of Ukraine, and of course the Fed interest rate hikes coming up as well. So by all accounts, it does show that the officials are getting worried about where China's economy is headed. They're talking about tax cuts and more borrowing and spending, but they're not talking about a major pivot away from the dynamic zero or the aggressive control of COVID in China just yet. That's because of a big political meeting at the end of the year, and it's all important that they keep the disease under control before then.
How much success, though, will they have in doing so? Thank you so much to Enda Curran, our chief Asia economics correspondent in Hong Kong. Now let's get back to the equity markets and take a look at some stocks moving in pre-market trading here in the U.S., all on the back of analyst action. First, you have an upgrade for CrowdStrike, the cyber company. It was raised at Goldman Sachs to a buy $285 price target, which would be about 32% upside from yesterday's close. It's up about 3% in early hours this morning, trading just shy of $223. It's a downgrade, though, for Cisco Systems. It was cut over at Citi to a sell. That stock already down 17% year to date. It's off another 2% or so this morning. And you also had a downgrade from Morgan Stanley coming for HP. $15 price target put on that stock this morning. It's trading right around that $15 level, down about 2.5% before the bell, Anna.
Coming up on the program, Kaylee Priya-Misra joins us, Global Head of Rate Strategy at TD Securities. We'll talk about the higher rates environment. And SPAC trades may have made up to 888% in profit. Now, some are drawing SEC scrutiny. You can read more about that in today's Big Take story by typing NI Big Take into your Bloomberg Terminal. Plus, don't miss Bloomberg Crypto today at 1 p.m. New York time, 6 p.m. in London. Matt and Kaylee will be speaking to billionaire Sam Bankman-Fried, CEO of FTX, a cryptocurrency exchange. We know Matt is excited about that one. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Season is coming.
The bar is pretty high.
We're going to see lower earnings growth.
The sentiment on financials has been pretty dour.
Bloomberg breaks the numbers first.
Tesla's gaining on record deliveries for the first quarter.
The industrial sector is getting hit pretty hard.
Every tick down is a big deal.
With exclusive expert analysis.
There are a couple of things that concern us.
We have to break out a different playbook.
There are opportunities out there.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on radio and television. I'm Matt Miller here in New York with Kaylee Lyons, Anna Edwards with us out of London. Now, I'm looking at a chart that if you're listening on radio, you can probably visualize this because it's a chart we've been showing quite often, not just in the last few days and weeks, but in the last few years. The question is, this chart, I guess, asks, are we at the end of the bull market in treasuries? And so many points along this chart, we've had head fakes where people have said, you know what, this is it. And maybe, once bitten, twice shy, the market's not going to believe it if it really happens this time. Tatiana Derry of Markets Live, the Markets Live blog from Bloomberg, joins us now to talk about this. And Tatiana, the difference now, I would say, is that it's also the steepest inflation that we've had in 40 years. So maybe this really is the end. What do you think?
Exactly, Matt. And the difference now is that the Fed is really determined to tighten. So if they were to deliver on these very hawkish expectations that they've set out here recently, I mean, we got the commentary more bearish and bearish, not least from Governor Waller yesterday, saying that there could be some damage under the, quotes, Fed heavy hammer. So if they were to deliver on that, there could be more losses ahead for bonds. And I think the next level we're watching here for treasuries is at 3%, as we at MLive have been writing about.
Okay. Okay, Tatiana, good morning. So that's the big macro story in focus. Another focus is earnings, of course, and we're heading towards the start of the bank earnings story. Many people are watching for clues on the strength or weakness, challenges for consumers. But you're watching for something else. You're watching LBOs, leveraged buyouts. What's the lead in there in terms of the earnings season?
Exactly, and so overall, if we look at take a step back for the S&P 500, it's expected to be a solid quarter, but for banks particularly, they're expected to have one of the worst quarters, and that's not least because of the IPO drought. We've seen the M&A slowdown, and as you mentioned, leveraged finance. We've seen billions and billions of debt holdings piling up onto their balance sheets. Those are holdings that they have been unable to sell because markets have been roiled by rising interest rates expectations. And here in Europe, we still have the longest junk bond drought since 2011. So even if they start coming and bringing some of that debt onto the market, it's going to take a long time till they can still get rid of that.
Okay, another angle to watch then on the bank earnings story. Tatiana, thank you very much. Tatiana Daria joining us here in London of the Bloomberg Markets Live team. And remember, you can get up-to-date analysis and insights from the Markets Live team. MLIV Go, that is the function to use on your terminal. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Now, keeping you up to date with news from around the world. Here's the first word. President Biden has unveiled new federal rules restricting so-called ghost guns. It's a crackdown on purchasers who assemble potentially untraceable weapons from kits. The Biden administration has been criticized for a rise in gun violence during the coronavirus pandemic. Employees at Twitter were scheduled to have yesterday off for the company's monthly day of rest, but Elon Musk made it hard not to think about work. Musk, now the company's largest shareholder, backed away from an offer to join Twitter's board, and a company-wide Q&A with him was canceled. Now employees say they are super stressed about trying to figure out what Musk will do next. Coming up, we'll get some clues as to what this bond market will be doing next. Priya Misra, global head of rate strategy at TD Securities, will be joining us. This is Bloomberg.
Nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. European stocks are falling again while US futures fluctuate and the Treasury 10-year yield exceeds 2.8%. Data coming out today may show that March was the high water point for inflation in the US. The estimates say consumer prices rose at an annual rate of 8.4%. Ukraine expects Russia to widen its offensive in the eastern part of the country this week. That echoes a US warning, which also predicted a, quote, more protracted and a very bloody phase of the war. Meanwhile, the mayor of Mariupol says that more than 10,000 civilians have died in the city since the invasion. And in China, a sign that COVID lockdowns are taking their toll on production and on spending. Premier Li Keqiang issues a third warning about economic growth risks in less than a week. Li told local officials that China will adopt stronger policies if needed to support the economy. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And of course, our focus later on in our European trading day, then, Matt, is going to be all about that US inflation print. Of course, we won't know till next month whether this is the high, but certainly an 8 handle will catch the market's attention.
I mean, I think if we continue to repeat every 10 minutes that this is going to be the peak, we're going to jinx it. You know, we don't know if it's going to be the peak. In fact, I spoke with Abigail Doolittle yesterday, who's a chartist. She looks at the technicals, and she said, from that perspective, no, this is not the peak. Right now, don't be fooled, by the way, by the little change in S&P futures, because it's a pretty exciting market day. We were down 1.7% yesterday in the cash trade, so not a lot going on here yet, but we had 10-year yields up over 2.8%. They're right about there now, 279.56, the highest level we've seen since now the end of 2018. And NYMEX crude coming back from the 4% drop we had yesterday, 97.35 right now. Brent also bouncing back a little bit. And speaking of a bounce back, Bitcoin, it's up. It's only 0.8%, but at least it's green on the screen, right? 40,177. So maybe that's a risk-on indicator. Of course, I'm sure that everyone, Kaylee, is going to be kind of sitting on his hands or her hands until that CPI number comes out.
Yeah, just about 3 hours to go. And also everybody is waiting for Bloomberg Crypto later today, 1 p.m. Eastern time, and we'll talk more about Bitcoin, Matt. I also am taking a look at things that are bouncing back in terms of equities moving in pre-market trading. NVIDIA is coming off of a 5-day losing streak. It's down 20% over the last 5 days, but a little bit of reprieve this morning, up about 0.9%. Same goes for Tesla. It's down about 8% over the last 2 sessions, but higher by about 0.6 in early hours this morning. And with that lift in oil that you were talking about, you're seeing a rebound for some of those energy players. The likes of Occidental, which was down more than 6% yesterday, is in the green by 1.5% early on this Tuesday morning. And then Wells Fargo was actually a stock that was higher yesterday. It was upgraded over at Citi, but it also is higher this morning, up about 0.5%. Of course, it will be reporting on Thursday, but it's JP Morgan that kicks off those big bank results tomorrow morning, Anna.
Yeah, a lot of focus on the earnings story. When you ask investors whether stocks can be resilient in the face of the pace of the rise that we're seeing in yields, a lot of their answers come down to earnings and just how strong that earnings story will be. So we'll focus certainly on that. The European equity story today is a weak one, though, Kaylee and Matt. We've got the Stocks Europe 600 down by around 0.5%, off earlier lows, but catching up really with the losses we saw on Wall Street yesterday. Commerzbank and Deutsche Bank both in focus. These two stocks definitely off their earlier lows. They were down by more than 8% in the earlier part of the trading day. And this is because one big shareholder is selling a sizable chunk, $2 billion they plan to raise, this investor plans to raise from the sale of shares in these businesses. And this follows on from a number of big sales of this nature that we've seen from the likes of Airbus, Glencore, shareholders offloading large chunks in some of these businesses in recent sessions. The UK 10-year yield also on the rise, just underscoring this global theme, the Treasury theme, but also the global theme about higher rates, and also drawing a focus to some of the UK data we've had this week. A really tight labour market story here in the UK, just as we've seen in the US, but they're slightly different, but similarities. Let's move on and show you the Russian assets right now. That global theme of global equity market sell-off continues to be a feature of the Russian markets as well, down by 2.5% there. The ruble fairly stable by recent standards, back down to 84, and this really interesting in the context of some of the comments we got from President Putin earlier about how he does not intend to cut Russia off from the global markets, but maybe the global players have other ideas, Matt.
Yeah, absolutely. Well, I think to some extent he controls the exchange rate of the ruble there, as we've spoken about before. Let's talk about the Fed. Governor Christopher Waller is warning about the economic damage that could come from raising interest rates. He spoke at a Fed Listens event yesterday.
We do not have a policy rule for every segment of the population. We don't have one for every industry. We have one. It's called the interest rate, the Fed funds rate. That's really it. So it's a very brute force kind of hammer that we use on the economy. And of course, when you kind of have to use a brute force tool, sometimes there's some collateral damage that happens. But we're trying to do this in a way that there's not much of it. But we can't tailor policy.
All right, so Christopher Waller talking about the collateral damage that comes from using a hammer. I'm looking at the bear steepening that we've seen over the last few sessions. It's been an amazing move up to, 40 basis points, as you can see here. Let's bring in Priya Misra, TD Securities Global Head of Rate Strategy, to walk us through the difference between a bear and a bull steepening. Priya, what's the difference here, and why does it matter?
It matters a lot. So what a bull steepening is lower rates led by the front end. A bear steepening is higher rates led by the long end. The reason I think it matters is the economy is actually impacted by longer term rates. I would actually take it one step further and say longer term real rates. And what we've seen over the last few weeks really has been the long end and long end real rates starting to rise. This is what ultimately impacts the mortgage market. This is what impacts the consumer. This is why I think the market's now getting a little bit overdone. I do think that the US 10-year can get to 3%. You know, this is largely due to quantitative tightening. This is also the entire global rate rise. But this is going to tighten financial conditions. This is going to impact the consumer. And this will actually, I think, prevent the Fed from hiking much above neutral. I mean, if you notice, the Fed's been saying we really want to get to neutral. And I think that's the easier call to make right now. By year end, by early next year, the market's pricing well above neutral. That's where your growth slowdown, recession risk starts to come in. But if the long end, to your point, if we bear steepen, I think the economy starts to slow down much faster than what I think is priced in. And that'll actually slow down the hiking cycle beyond neutral.
And Priya, tie this into the inflation data that we're going to get out later. If the inflation data is as hot as it is expected to be, and if we are going to see tighter financial conditions, are we going to see consumers pulling back? We're going to see US consumers not able to spend in the way that they have done in recent weeks, and therefore putting downward pressure on inflation.
Right. So you bring up the biggest risk to this entire outlook is if inflation remains extremely high. But I would say we're going to get the CPI number today, but there's also wage inflation. So inflation is a problem for the consumer. But if wage inflation is being able to keep up, then the consumer, can be more resilient. Now, our view is that wage inflation has been high, but it's going to stall out here. We do think labor force participation is going to rise. So we'll be watching not just CPI, but also wage inflation. Of course, today we get CPI, and I would say as somebody that looks at forecasts, it's notoriously hard to forecast inflation. So there's wide error bands. We think the number is going to stay high. Rent inflation has been extremely high. That tends to be trending. But I think the Fed is responding. What I worry about is inflation by year end. Will that start to slow down? So do we have a trajectory where the Fed can say, look, inflation's going the right way. It still might be a little bit high, but we really want a soft landing. That's the part where I would say today's number is going to be high. But do we see the trajectory? And we're not going to know this today, but in the next few months, do we start to see a trajectory of wage inflation stalling and of CPI putting this high watermark sort of behind us? That'll ease some pressure on the Fed, but it's really hard to know. There's so much going on with the COVID lockdowns on one hand, with the war. So it's unclear whether we actually get that downward trajectory.
Priya, I want to ask about real yields, because right now the 10-year real yield sits at just negative 13 basis points. We have seen a very, very rapid move to the upside. Do you expect that it goes positive, and when?
So, if you look at the 10-year, it's the front end of the real rate curve is sort of pinned extremely low because inflation is that high. So I actually look at five-year real rates. They are positive. They've gone from very negative to positive territory. That's ultimately telling you that, that's tightening financial conditions. I do think 10-year real rates will move up over time. We do need inflation to put that high watermark behind us. And I think ultimately, I'm glad you bring that up, because really if the rise in rates is led all by inflation expectations, the economy doesn't get as impacted when it's real rate led. And I think these five-year real rates closer to 1% is going to really start to hurt the consumer. So there's still a little bit more room in that real rate trade. I think quantitative tightening is ultimately what impacts real rates. That's why we've had this move higher. I do think there's another 20-30 basis points further increase in that 10-year real rate that you bring up.
On the subject of QT, what does it equate to if it were to be in basis point terms of a hike? Is that like 25 basis points? What number would you put around that?
Sure. So I would actually say that it's a non-linear impact. A lot of the studies suggest that about 700 billion is worth one hike. But, I think it oversimplifies it. The first 700 billion might be worth one hike. I think the second 700 billion could be worth a couple of hikes. And the reason for that is supply starts to weigh on the market. We keep needing to find the marginal buyer. Who's the marginal buyer for treasuries? We have auctions. We have an auction today. We have auctions 3 weeks in a month. So I do think there's a non-linearity, particularly as interest rates get to neutral. So by year end, I think that QT starts to have a much bigger impact, which is why I think real rates rise, and then that actually slows down Fed hikes. But yeah, there is some equation, but the estimates are actually all over the place, I think, because it depends on how much QT has actually already happened.
Okay, so finding that marginal buyer becomes maybe more difficult as the Fed continues to step back. Priya, thank you so much for your time. Good to speak to you. Priya Misra joining us there from TD Securities. Thanks for speaking to us here on Bloomberg TV. And coming up on the program, Rudiger Bachmann is a professor of economics at the University of Notre Dame, and we will be speaking to him shortly about expectations for German growth, given energy questions that hang over the economy, but also the global threats around recession. This is Bloomberg.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
When we look at the current economy and the current economic circumstances, what stands out globally is the degree of resilience in the American economic recovery. So we are facing a lot of uncertainty. We're facing rocky waters right now, but the United States is probably better positioned than any other major economy to navigate effectively through them. Why is that? Strong economic growth, strong household balance sheets, a strong American consumer, and an incredibly strong labor market.
Brian Deese, U.S. National Economic Council Director, speaking with Bloomberg yesterday. Well, a new study says the risk of global recession by the end of the year is rising. According to the Peterson Institute for International Economics, there are a combination of factors, among them the highest inflation in 4 decades, the war in Europe, and slowing growth in China. Rudiger Bachmann, professor of economics at the University of Notre Dame, joins us now for more. Professor Bachmann, let's focus on the war in Europe and Europe, therefore, in particular. You say that an energy embargo would lead to a recession in Europe and particularly in Germany. What about the absence of an energy embargo? Is Europe heading for recession regardless?
Probably, although, so the latest numbers are still positive growth, but often these numbers are a bit sluggish. The forecasts come in sort of a bit lagging. So I wouldn't be shocked if it ultimately is a recession. I think it's too early to tell. But in any event, the growth numbers have been corrected downward quite a bit.
And what if they decide to take a stand against Vladimir Putin and cut off oil and gas imports? Is that then inevitably going to lead to a recession for Germany and the rest of Europe?
Yes, that will lead to a recession, and will lead to a severe recession, in fact. So I and others have looked at this. There are now a number of studies out there, and we are talking anywhere from, say, -1% to -6%, so a really severe Corona-type recession, if you will.
Are there ways to, help dampen those negative effects, Professor, that Germany could take? Otherwise, maybe it's not worth it, I guess, to take that stand if you're shooting yourself in the foot at the same time.
Well, but it's a question whether this is really a shot in the foot, right? So there are indeed economic policy measures you can take, and some of it comes straight out of the Corona playbook. We know how to do protection umbrellas around affected industries. We know how to do short-term work programs so we can avoid mass unemployment. So how bad it's going to be is indeed a function of good economic policy. That's a mixture of getting more gas supply, which the current German government at least is doing very well, but also cutting down on gas demand, which I don't think they are doing very well. Quite the contrary, they are subsidizing energy prices right now, or that's where the economic policy packages are heading. I think that is actually a recipe for disaster. And then, should it actually come to an embargo, you need these protection programs for industry and workers. And then, in addition, you also need a monetary policy that kind of will fight the inflation coming out of this. So if it's a mixture of policies, also social policies, to avoid social unrest, I think it can be handled the way we handled the Corona recession, which did not lead to an economic calamity, although on the books it was a pretty severe recession.
Professor Bachmann, good morning. You talk about a range of outcomes for the German economy if we did see an embargo on all Russian energy, ranging from a recession of -1% to -6%. What is it that dictates whether which end of that spectrum we end up?
Well, partially, I think the quality of the economic policy, and partially, I mean, so why do we have such a big range? This is not a normal times where you can do sort of your normal business cycle forecasting. And the studies I've seen are not attempting to do sort of your standard business cycle forecasting. The studies are there to get an order of magnitude. Are we talking about an economic calamity, the way the German government is painting it right now? The way, for example, we have seen it for Greece. Greece had a -20% GDP reduction through the austerity policy. Are we talking about economic calamities of that order of magnitude? Or are we talking about something in the single digits? And I've not seen a study that goes beyond the single digits. And I don't think we can do more, quite frankly, as an economics profession, given the high level of uncertainty. And I'm not even talking about China right now, where we have sort of a second crisis center with China's Omicron problem.
Yes, and let me ask you about that, because at a global level, are you expecting to see a recession? Kaylee started this conversation with you, citing some research from from other economists that talks about how that prospect is rising. But for many, they say, look, we're going to see a slowdown in growth, because growth has still been rebounding from COVID lows, but we're not going to see global recession. How does China play into that calculus?
I think China is a major danger for the global economy right now. And I think it's frankly underestimated. And it goes in both ways. It will lead to a renewal of the supply chain disruptions, and it will contribute to already high and rising inflation. So I'm not in the business of actually business cycle forecasting. You have people on Wall Street and in London, in the city, to do this. Yep. The quant shops to do this forecasting, but I think we see a severe danger of a recession combined with high inflation.
Professor, we're watching with alarm the developments in Sri Lanka. There was unrest, first riots around the palace. Now they're going to default because they don't have enough dollars to pay for food and fuel. Is this the kind of situation that could spread?
It may very well be. After all, we are in a major war right now. And you know, wars are just never good times. And so wars beget crises around the globe. And we still aren't really out of the global pandemic, I think. If, you know, 1/6, 1/7 of the world population is still basically under a major threat of the global pandemic, then we aren't out of it. So you have a major war combined with a global pandemic. I don't know what else that is other than the mother of all crises.
Professor Bachmann, thank you very much for your time. Rudiger Bachmann, University of Notre Dame, Professor of Economics, thank you very much for joining us. Coming up on Balance of Power later today, U.S. Council of Economic Advisors member Heather Bauchi. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lines in New York. Anna Edwards is with us out of London. Now, Tom Keene, co-anchor of Bloomberg Surveillance, joins us to talk about typically his single best chart. Tom, I guess you're going to be focused in on the fixed income market because it's so fascinating to watch what's going on with spreads, with real yields, and the possibility of the end of the bull market.
And you guys done a great job in the last hour. I stole this from The Economist, one D. Berger. Let's look at the Berger chart, folks. It's very simple. This is the chart the pros are looking at. Danny Berger featured it earlier. Matt Miller stole it from Danny Berger, and I'm stealing it from Matt Miller. This is the acclaimed H15 series, which goes back to Eisenhower, up to the Volcker inflation, and down we go in the Great Moderation. It's a log chart, log y-axis, slope matters, percent change, and what you need to know on a standard deviation basis, those circles down there, we have moved from negative 4.7 off the trend to plus 2.5. Matt, I have never seen that in my lifetime.
It's pretty amazing.
And you're going to be
Well,
and you're going to watch how these bond markets respond then to the inflation data later on, Tom. Which of the guests you've got coming up that you think worthy of mention?
Well, if there's any number to talk to, I think Seth Carpenter will have a global view on this with Morgan Stanley, and of course he's working off the good work of Ellen Zentner. But as Matt mentioned earlier, Anna, it's extraordinary what we're seeing here. What I do is I call this convexity. It is the acceleration that is there. It is the rate of change which is there, which is giving everyone in the game pause.
Yeah, it's really the rate of change that I think is freaking out markets to some extent. Tom Keene there, co-anchor of Bloomberg Surveillance. Thanks very much. Look forward to the program. Of course, we are focused on inflation today. Anna, the CPI coming out in just about 2.5 hours from now. I'm watching it very closely. You know, at the top of the hour, we got headlines from the Biden administration. They're going to allow the sale of higher ethanol gas in a bid to ease costs at the pump. And maybe that's good for your wallet, but not so great for your engine.
So inflation and all its dynamics very much in focus as we work our way through this trading day. European equity markets off their earlier lows, but still negative. US futures fairly flat. NASDAQ futures actually bouncing a little bit this hour. Bloomberg Surveillance, more follows. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Situation has been very, very positive for equities.
What we're really seeing now is an increase in volatility.
How high do rates really need to go to slow down this economy?
What QT does to financial conditions as well, that's another unknown in all of this.
The risk of recession is really no higher right now than it normally is.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Bramison, Tom Keene on a Tuesday. It's a different Tuesday, Inflation Tuesday. We welcome all of you on Bloomberg Radio, Bloomberg Television. Lisa, today's number is 8.4%.
Perhaps. Maybe it's 8.6%. Maybe it's higher than that, or maybe it's lower. The spread between some of the economists' expectations are wide. We're talking consumer price inflation that could be the highest going back to 1981, on the precipice of the fastest tightening cycle that we've seen from the Federal Reserve going back decades.
We're going to spend a lot of time framing out on surveillance today, the rate of change, the speed of movement, and you see it in full faith and credit, Lisa. What does full faith and credit move here, Lisa, to you? The signal here of 2.79% 10-year yield, what does that signal to fixed income Wall Street?
There's one thing about today's number. There's another about whether we go back to an inflation rate that seems familiar over the past few decades, or are we looking at a new normal of a higher inflationary rate? And that means higher benchmark nominal rates on Treasury yields. How much are we looking at that as the new normal? And what does that mean for the trillions of dollars of assets that really have been pegged to near zero rates for so long? And that, I think, is still unknown.
And now, folks, we stop the show here at 6:01:20 Wall Street time to talk to Abramowitz about the 30-year auction. It's auction time here at Bloomberg Surveillance. I mean, we're at a point, seriously, Lisa, where the price movements are so abrupt. I'm going to admit it, dare I say, the auctions matter.
Wow, look at this. Who are you? What did you do with your tank?
It's my inner Pharaoh.
Honestly, channel your inner Pharaoh and just ignore the Dow. Honestly, there is a 10-year auction today, and it is going to be very interesting. How much do people swoop in and see this as a buying opportunity versus perhaps just basically picking up nickels ahead of the steamroller if we are looking at a new regime? And going back to that Amazon bond sale yesterday, a lot of the commentary was this is an outlier, right? They're actually locking in borrowing costs at a time when they're rising quickly, perhaps ahead of what they see as further price declines and yield increases down the line.
Life goes on. John Farrow, a little partly cloudy on Capri this morning. He gets up to 62. Kaylee Lyons doing extra duty for us this morning. And Kaylee, it is an inflation that goes from sea to shining sea.
And from large businesses to small, Tom. I was just taking note of the NFIB small business data that just crossed the wire. First of all, you had a deterioration for a third month, coming in below economist expectations at 93.2. The estimate was for 95. But what's interesting here, 31% of respondents reported inflation as their biggest operating challenge last month. 72%, Tom, are raising prices. And of course, it is those pricing power exercises, passing higher costs on to consumers, that maybe creates a problem for the Federal Reserve as well.
Before we get to the data, Lisa, we have to touch on this war in Ukraine, a horrific news flow that we see. And I want to wrap it this morning, Lisa, about something you've been out front on, which is agriculture in Europe. One of the measurements there is literally out of Dunkirk and Rouen. It is European milling wheat number 2. It's up 75% in one study off the bottom, a bit ago. And it's now a medical chart up 6 standard deviations. Food expensive because of Ukraine.
To me, this is going to be the biggest story of the next 6 months. And we're going to be speaking with the IMF on Thursday. I want to hear how they're addressing a lot of the nations that rely on Ukrainian and Russian wheat and are really seeing some increasing social tensions as they're dealing with these prices. How do you deal with people who are hungry? A new dynamic that goes very differently than some of the economic, more esoteric reads that we look at every day.
In the coming weeks with our American bias, we're going to bring in some European data here. Bloomberg very strong at that with some of our partners across the continent of Europe. Oil back to $102 a barrel on Brent. Crude, I really got to show dollar dynamics. DXY over 100. We'll get to Mark Chandler of Bannockburn in a moment. Euro under a 109 gets my attention. Yen with some boring stability. Equity markets, red and green on the screen. Futures not part of the discussion. VIX, after 2 challenging days, Friday and Monday, 24.39 on the VIX. That gets my attention. Lisa, tell us what's going on.
We all know what's going on. It is the big CPI Tuesday that we have been waiting for, although perhaps it doesn't matter. And this is perhaps what we're going to hear from a growing number of people who come on the show today. 8:30 a.m., we get that read. Estimates for the month of March range from 8.2% to 8.6%, all around the same level. 8.6% would be the highest going back to 1981. Does it matter? Well, it depends what the trajectory trajectory is after. I was looking at a number of analyst reports. They came out and they all were saying, this is probably the peak in inflation. Okay, great. But where does it drop back down to, right? What are we looking at over the longer term? And if you take a look at inflation expectations over the next 5 to 10 years, they've risen to the highest level since 2014, although still relatively low at 2.5%. How much do we get inflation dropping down below 4% next year? That's looking less likely. We're hearing from even Bloomberg Economics, and that, I think, is really the nature of the conversation.
I want to interrupt here. This chart, folks, on radio, it's the 5-year out and then 5-year out further chart. Lisa, this is my fave chart on inflation. It's the one I've used for years.
And it's the one that a lot of people look at. Today, we'll hear what the Fed thinks about it with a number of speakers, including Fed Governor Lael Brainard, who's going to be speaking at 12:10 p.m., and Richmond Fed President Tom Barkin at 6:45 p.m. It's been a huge roster of Fed speak over this week. And frankly, even the doves are hawkish. This is the takeaway. They all are considering even the potential for a 50 basis point rate hike, not only the next meeting, but a subsequent meeting, and maybe even a meeting after that. And at 3:45 p.m., we hear from President Biden. What's he going to do about the fact that CPI is going to hit the highest since 1982 or perhaps 1981, as he comes out and tries to talk about some of the issues that he's doing and some of the measures that he's taking, including having to do with ethanol and fuel, which they were just discussing. Meanwhile, consumer sentiment we get on Thursday has fallen to the lowest since 2011, Tom.
A nice way to end that. Confidence very challenged here. And I'd mention this. I don't know if we can get this up, but the mortgage rate has exploded higher in housing. You need to explain to me, folks, how the American housing economy adjusts to a spike in mortgage yields back to where we were in 2010. Mark Chandler, the perfect guest to start the hour and the show, chief market strategist, Bannockburn, and decades of experience in foreign exchange. What is the signal, Mr. Chandler, of a strong dollar DXY through 100?
Yeah, I think that the Federal Reserve, since it's in a tightening mode, a stronger dollar acts as consistent with that. That is, it helps the Federal Reserve tighten policy. It's a positive thing. Typically, central banks want the currency to move in the same direction as monetary policy. So far, I'd say that while the Japanese have been objecting a little bit, sort of escalating their rhetoric, I think that there's nothing really standing in the way of a stronger dollar here, as long as the Fed continues to be on this path towards an aggressive tightening cycle.
So, Mark, if you do look at the possibility of growth slowing in the face of some of these rate hikes, at what point does that challenge the dollar? At what point are we actually pricing that in? Because any weakness in the U.S. economy will be met with even more elsewhere.
Yeah, no, I think you're right, Lisa. This is really the key point, I think, is the Federal Reserve is going to raise rates until something breaks. And what's going to break? I suspect it's going to be the consumer. To Tom's point about the housing market, we're going to get to housing starts as well as existing home sales next week, and we're going to see those fall. And so I think that this is the path we're on. The economy is likely to accelerate after this weakness in Q1, and then the challenging part, I think, is in the second half of the year. Remember, monetary policy takes place, has an impact with this unpredictable lag time. And so sometime around the second half of the year, I think that we're going to begin seeing the economy slow. And when we finally get a quarter below 2% or sustained growth below 2%, I think that's when the Fed calls it quits.
Mark, I have a new habit when I come into the office around 2:30 a.m. I look at dollar yen first thing. Lowest since the weakest since 2002 this morning. We're north of a 125 handle. How much further can that go?
Yeah, it's very interesting, huh? So we're at a level since 2015, as you say, and I think that this is where, if the challenging point, the Japanese officials, and even including this morning, the finance minister sort of raised his rhetoric, talking about watching the market vigilantly. And I think that this is just a sign that up until now, the Japanese have been arguing that the weakness of the yen is really positive for the economy. But I think that they're slowly changing their tune, and so they're climbing an escalation ladder. But I think if we get much above the 126 area, the next stopping point, the next chart point is closer to 130. But again, I don't really think that we're seeing the kind of objections from U.S. industry as we've seen in past times, especially the auto sector, which has often been sensitive to the yen weakness. And even the Japanese, I don't think what's happening really, I think, is that the Bank of Japan has targeted 25 basis points on their 10-year bond. 25 basis points. And what we're going to see is starting next month, when we get this month's CPI data, it's going to jump in Japan. And so real interest rates in Japan are on the verge of falling sharply. And I think this is one of the factors that are continuing to lift the yen. And so here, too, I think it's sort of like that old quote from one of the Russians 100 years ago, saying, when you feel mush, push. When you feel steel, retreat. And right now, I think the market's feeling mush.
Right, Mark, we got to leave it there. Mark Chandler, thank you so much with Bannockburn this morning. Red and green on the screen, futures up 1. At least I look at this, it's all about this inflation report and frankly, beneath the headline data as well.
Yeah, and what this does in terms of economic growth, I mean, Kaylee was mentioning that NFIB, small business optimism data that just came out just moments ago, and it came in well below where the expectation was. Again, just another confirmation of how these inflationary pressures are weighing on the economic outlook in a way we haven't seen since 2008.
We'll have to see. Kaylee, I look at the inflation breakup here, and I actually looked at a gas station sign the other day. I don't drive, folks, and it was a Shell gas station with the prices where they are and such. But it goes way beyond that. And I again look at food. I'm looking at corn in the United States, the wheat we just showed in Europe. I mean, these are tangible spikes in price.
And these are staples, Tom. These are necessities. Food and gas is obviously one of the most visible price increases to the American consumer. Lisa was talking about 2008. Tom, did you see the Bank of America Fund Manager survey this morning? Global growth expectations, record low. Stagflation expectations, highest since 2008.
Yeah, so no question about that. The stagflation out there. Otmar Issing with an incredibly important interview. I believe it was with the FT this morning. Stay with us. This is a day of an inflation report in an hour, 2 hours and a half, I should say. This is Bloomberg. Good morning.
Keeping you up to date with the First Word News, I'm Ritika Gupta. President Biden will allow expanded sales of higher ethanol gasoline in an attempt to lower fuel prices. He'll make the announcement today during a visit to an ethanol mill in Iowa. Ethanol is commonly made from corn. The White House estimates that using the higher ethanol gas could save drivers 10 counts a gallon. Ukraine expects Russia to widen its offensive in the eastern part of the country this week. That echoes a U.S. warning which also predicts a, quote, a more protracted and a very bloody phase of the war. In the city of Mariupol, the mayor says that more than 10,000 civilians have died since the invasion. In Shanghai, there has been a slight easing of COVID lockdown restrictions. Still, the vast majority of the city's 25 million people are subject to curbs, which keep them in their homes or compounds. Meanwhile, the U.S. has ordered that non-essential employees and their families at the Shanghai consulate leave the city. Sri Lanka is taking an extraordinary step to save its dwindling pile of dollars for essential food and fuel imports. The government is suspending payments on some foreign debt and warned creditors of a possible default. There have been widespread protests in Sri Lanka against 20% inflation and daily electricity outages. And in the UK, retailers warn of clouds on the horizon. There was a sharp slowdown in sales last month as higher prices cut into consumer spending power. Sales were up just 3.1% from a year earlier when the UK was under coronavirus restrictions. That's according to the British Retail Consortium and consulting firm KPMG. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Surveillance Worldwide. We welcome you around the world to images of Mr. Putin. He is in the far east of Russia with a gentleman from Belarus, Mr. Lukashenko, and this is one of his projects easily over the last 12 years. The Russian space program is wedded to Kazakhstan. He does not like that. He wants his own shop, and he is building it. And Lisa, help me here with your Russian. Vostochny Cosmodrome, which is 400 or 500 miles in from the Pacific. And no doubt talking with astronauts here, signaling that life goes on in his fractured Russia. Lisa, it's a Mr. Putin we've seen mostly at a long table.
And that's the important point here. This is his first trip outside of the country, although Belarus is obviously very closely affiliated with Russia right now. But it's his first trip out, first reported trip, I should say, outside of Moscow since this war has started. So a real show of international mobility that we haven't seen. How much do we see this as a precursor to possibly Belarus's more intimate connection with Russia in this effort in the war in Ukraine?
We will let the experts look at Mr. Putin here and suggest his health, etc., but he has to be focused on the trip back to Moscow, on the challenges of Ukraine. Lisa, in my reading today, Ukraine, I guess, is about wait for which side is going to begin, without the romance of World War II, what appears to be a land war.
Yeah, although we are hearing about an intensifying effort in the east, in the Donbass region, and there have been reports about alleged allegations from the Ukrainian side about possible chemical warfare, have not been confirmed. If that were the case, it would be an escalation that would have to warrant some sort of response, a further response from the West, and that, I think, is sort of the nature of the conversation right now.
We go to Emily Wilkins on radio. Images of Mr. Putin now speaking clearly to astronauts dressed in the blue. They're more relaxed outfits, not in astronaut gear, but with rockets in the background as well. Emily Wilkins, it may be a diversion for Mr. Putin, but he must be focused on the response of the West in today's response from President Biden. What will the President of the United States do?
So we're going to see President Biden actually travel to Iowa today. He's going to be talking about, of course, gas prices. Of course, he's going to be speaking about inflation, and he's going to be blaming that rise in prices squarely on Putin's shoulders. They've been branding this, the high oil prices, as something that has happened because of Putin's invasion in Ukraine. And this does come at the time where the U.S. and its European allies are beginning to rethink the weapons that they're sending to Ukraine. As the war shifts, what different weapons do they need in terms of
of heavier weapons, in terms of longer range missiles. You're seeing more discussion on that, both in the U.S. and in Europe, as they try and prepare for this next step of the war, now that we really haven't seen sanctions be the gut punch that a lot of leaders initially hoped they would be.
All right, so what's next? Because we are dealing with two different shocks here, right? I mean, it's sort of in tandem that President Biden is trying to blame some of the increase in the cost of living on people, while also talking about going further in terms of being more aggressive with Vladimir Putin. What takes priority at a time when certainly there is a view to France and how really the cost of living is the main issue for a lot of voters heading into the midterms?
I think that's a really interesting point, Lisa. I mean, you have a lot of angst among Americans at these higher inflation prices, at these higher gas prices, but you also have in the U.S. a strong sense of support for Ukraine and wanting to support Ukraine, and a very negative opinion of Russia. And so what you're kind of seeing Biden do here is combine these two. Tell Americans, look, we know that you're angry about high gas prices. We know that you don't like this inflation, but you can blame Putin for that. Of course, that's only a small piece of the larger story on what's happening with inflation, what's happening with supply chains, but it's the part that Biden's really going to wind up pushing because he knows that that will resound with Americans.
Well, and obviously the president is dealing with the politics of inflation. On the geopolitical front, of course, he also was talking to Narendra Modi yesterday, the Prime Minister of India. Is there real signs of tangible progress from those countries like India, like China, who have so far not come out to criticize Russia for the invasion of Ukraine? Does it feel like we're moving an inch on that front?
I mean, Kaylee, we haven't seen a lot of action yet at this point. Although really what President Biden told Modi yesterday, it wasn't to ban Russian oil from India. It was that they should not be increasing or accelerating what they're buying from Russia at this point. And so the ask was kind of low here. So it'll be interesting to see going forward what India does. We did have a headline, a good story on the terminal today about India deciding to increase its shipments to Russia by $2 billion. That's not energy, but it's things like textiles, pharmaceuticals, machines, chemicals. And so it'll be interesting to see how that relationship between India and Russia continues and whether U.S. pressure might influence that at all.
Emily, I want to talk about the sanctions. We're going to lose this right now. I'm watching the feed that we have, folks, on Bloomberg Radio of Mr. Putin. They're in a photo op right now at the Cosmodrome in the Pacific. It's a little bit nudgy video, but we're going to go with this. It's so original to see Mr. Putin shaking hands with the leadership of the Cosmodrome, again, about 500 miles in from the Pacific Ocean, as Mr. Putin exit to other worries. I'm going to editorialize Lisa. He looks tired. He seems to be limping. Let's watch here for a moment. I think we've got Mr. Putin with a bit of a limp there as he signs the parchment. Lisa, your thoughts?
Well, I don't want to speculate on his health. I think that it's honestly interesting timing, this show of international clout or ability for him to move from one place to another at a time when many people are speculating about his increasing isolation. How much is he trying to shore up allies? What kind of pressure does this put on China in particular, as we do see India working more closely, or perhaps working more closely with the U.S.?
Emily Wilkins, no one rips up the script like Emily Wilkins. Thank you so much, Emily, this morning in Washington as well. We need to get back to the market story here. In 2 hours, an inflation report that harkens back to what Paul Volcker struggled with in 1979 into 1980, the double recession of 80 and 81. Kaylee, the shock here, what is it like to be of a younger vintage, Miss Lines, confronting inflation of my youth?
Well, I am focused on housing prices, Tom. You were talking about higher mortgage rates. I have to move in about 2 months. My lease is up. There is little inventory here in New York City. All of the prices are way larger than pre-pandemic. There's a surveillance park bench.
There's a surveillance park bench in Central Park. You can sleep under.
I thought you were going to say I could move in with you, Tom. I thought that would be the offer on the
dogs,
table.
Surveillance park bench. Yeah, that's for a party of one.
Way too much maintenance. Again.
Yeah, especially, yeah.
No, but housing inflation, it's a very real thing that the Federal Reserve obviously has to consider. And of course, one of the most direct mechanisms through which the Fed can try to rein in the economy through higher interest rates is on higher mortgage rates. Maybe try to cool down the housing market first. But again, we're talking about a potential 8 handle on inflation. And my question this morning, Tom, is does it even matter, or has the Federal Reserve already made up its mind?
Well, they've made up their mind, and when the facts change, they will change. And Lisa, that's the heart of the matter. It'll be the parsing of inflation, the goods dynamic, the service dynamic. But it's actually a Fed that's committed. And far more importantly, so when we're in Washington, Madame Lagarde will be there at the IMF.
Right, and we're talking about the ECB having their meeting this Thursday as well. At what point, I go back to Tom Kennedy's question of JP Morgan Private Bank, at what point do these higher yields actually restrict economic momentum? At what point do they actually rein in inflation? We don't know, Tom.
We'll have to see here. Futures at -3, Dow futures at -38. Stay with us from New York on radio, on television, this day of inflation reporting. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2-neutral mobility. So we have flicked the switch there, and really we're going to step-by-step electrify everything. And what does that mean? Combustion engines get electrified.
Mr. Putin in the far east of Russia, and now Mr. Macron getting an earful out campaigning. The president of France, and I'm going to butcher this, Lagarde's watching this morning. I'm going to be in the Lagarde timeout chair. Mulhouse, Moose? I don't know.
Oh, come on. Really?
It's on the flight path into Zurich. When we go to Davos, Lisa, you're coming in on the plane. You're having your little brekkie thing, you know, the croissant and all that. And this is in the very east of France, right up, buttressed against Switzerland.
You might want to put a little bit more work into Duolingo. I mean, I guarantee you, you might get some pronunciation for brekkie, meaning breakfast.
Mulhouse.
Okay.
You don't say the H in French, Tom.
Mulhouse. Okay.
Let's move on.
He's getting an earful here, folks. And of course, we'll have our coverage here led by Francine Lacroix and Caroline Conan of this election. I believe it's April 24th. Macron and Le Pen. Let's move on. And of course, she is watching the French elections. Is one example of the new autocracy worldwide, the strident moment that we live in. And that is Joyce Chang, chair of global research at JP Morgan, herding cats, dealing with Bruce Kasman every day as best she can. Joyce, give me the new theme at JP Morgan. You wrote most of Diamond's 44-page letter. What is the research theme of your shop into the rest of the year?
Well, you know, we've taken first half growth down quite a lot because of Russia, Ukraine, the higher energy prices. I mean, in Europe, we're down 3 percentage points on first half growth. So right now, what we're looking at is really the first energy crisis in the decarbonization era. And what Jamie's been writing about is the need for a Marshall Plan, something where we actually look at how we can accelerate this transition, ensure our energy security, and also just get used to a world where we're in place for more volatile cycles, higher inflation, higher treasury yields still to come. So there's a lot to watch right now in the commodities markets.
Right.
We're beginning to see just a lot of those pressures still with us.
You know, I look here, Joyce, at the Marshall Plan of JP Morgan, and I look at David Folkerts-Landau, the academic over at Deutsche Bank, saying the same thing. There will be a massive fiscal stimulus in Europe, whether they like it or not. And then I've got Otmar Issing, the giant of Germanic economics in the FT, screaming, enough, we need to tame inflation. Describe those two forces pushing against each other, government fiscal stimulus versus a titanic fear of inflation.
Well, I mean, we're looking at very broad-based inflation right now. It's not just energy prices. I mean, taking a look at what we see in Europe, the surge in the euro area, we see that natural gas prices have actually pushed inflation above 15%. And looking at the U.S. And global inflation tracking close to 9% in the first quarter of the year. So there's also rent inflation, there's wage inflation. So these inflationary pressures mean that the central banks really are going to have to respond here. And we do see them moving 50 basis points in the next couple of moves. We do see that more stimulus is probably going to have to come online in China, particularly where growth is coming down there, but also in other places. We're seeing now the first discussions on whether there are going to need to be some subsidies, some automatic stabilizers that are put into place if energy prices stay at these levels. And we do see Brent oil staying above the $100 mark here.
Joyce, at what point do rates become restrictive? How high do benchmark overnight borrowing costs have to go before it actually has an impact on inflation?
We really see the Fed's fund rates getting to 2 7/8 next year, and then you have more of a pause. But I think they're going to move 50 at the next two meetings. You'll revert to 25 basis points in July and thereafter. But I think the issue is to get to neutral as quickly as possible and see where it settles, see if you can anchor inflationary expectations.
But to your point about oil at 100 and the fact that China is slowing down, at what point are we looking at these dueling shocks where basically these inflationary pressures are going to take some time to roll over, are exacerbated by the shocks, and will all inevitably conspire to a slowdown that people are not accurately pricing?
Yeah, well, everybody has first half growth down, but then they have this tilt up in the second half of the year. And that's really what remains to be seen. And we're going to see a lot of, stress that comes in other parts of the world, apart from the U.S. and Europe. I mean, if you take a look at emerging markets, food inflation is as much as 40 to 45% of the basket in certain countries like India, in the ASEAN countries. So these pressures are going to be with us. And I think that we've made material downward revisions to growth. But the question is that going to continue in the second half of the year? And all eyes will be on China, because we are seeing that the numbers that will come out for March and April are really going to come down materially as they've increased the lockdowns. The lockdowns in China, they're affecting really the equivalent of more than a third of GDP right now.
Well, of course, it could have a direct impact on Chinese growth, Joyce, but at the same time, a lot of production is housed in China. We've seen the impact it's already had on companies that have production in Shanghai. If supply stays constrained to a certain extent, potentially exacerbated by China's COVID-0 policy, how much is the Fed acting on demand actually able to make a difference? We talk a lot about the Fed's ability to engineer a soft landing. What about their ability to actually engineer a rolling over in inflation?
Well, I mean, I think there's the Fed hikes, but there's also the faster QT to come. You know, we really do see it's the combination of the two things, but it's also doing 50 basis point moves to try to anchor the inflationary expectations. So I think the Fed is in the front seat taking the lead on this, but we are seeing that across the developed markets and the emerging markets. I mean, there's more rate hikes to come here, but I think that on the oil side, releasing from the Strategic Petroleum Reserve Fund, we don't think you're going to get to some of the worst case scenarios that we had thought about with higher oil prices. I mean, there are still ways in which in the oil market, that's a global market, actions are being taken right now.
Well, and obviously, when faced with higher prices at the pump, when faced with higher prices at the grocery store, in theory, at some point, higher prices are going to alter consumer behavior in a more material way. When do you anticipate that real demand destruction may kick in?
I think that that's still a ways away. I mean, the mobility, the summer driving season that's kicking in. I think that demand destruction will happen, at some point in time. But, we are not in the scenarios now where we see oil over $130 per barrel. We're more in the range of looking at, $110, still seeing oil prices very elevated. But I think that you have a lot of pent up demand here still as the mobility comes back online. So that's going to take some time. And I don't think it's going to be something that we see in the next quarter or so.
Joyce, let me ask you a sell side question. It's on everybody's mind right now. Whether big tech, I mean, we saw the Amazon bond deal yesterday where they effortlessly go out. I don't know, maybe you got a phone call from Mr. Jassy. I can see Jassy. Get Shang on the phone. We need to move $5 billion of this. What do you think about the vibrancy of big tech in America?
Look, I think that this is a pandemic that has really, just changed the way that we live, that we work, the dependency that we have on big tech. So, yeah, we still see that there's pressures that are going to be in the equity market. A lot of that coming off of, the growth numbers, the higher energy prices, the fact that we had just such a massive rally. But I don't think that changes the overall story, for tech, for what we actually need now as consumers, as we're all coming back into the office and getting back to normal.
I do want to just ask you, Joyce, as you talk about big tech, a lot of it has to be tied to the bond market, which has given a lot of the relative valuation trade to big tech. How concerned are you about the bond markets, I don't want to say breaking, but breaking in terms of the lack of liquidity as the Fed withdraws? How much is that going to color the narrative in a way over the next 6 months that perhaps is different than even the rate hikes?
Well, I think that, now 10-year yields are at a 3-year high. They're finally looking like they're fairly priced, but I think that has further to go. Now, this year, we're looking at about $200 billion of treasuries that will run off this year compared to relative to our baseline forecast due to a faster normalization that's occurring. I also think that the Fed is fully on board on selling, MBS to get to an all-treasury balance sheet by the middle of next year. So I think, MBS sales are a real possibility in 2023. I think that the sales might actually take the form of setting a floor on the runoff rather than a cap on the runoff. But I think Treasury yields still have higher to go here, we have the